Hello everyone, welcome to this CA Final Advanced Financial Management Revision Series. Today we are going to discuss a chapter that is futures. See, futures comes under derivative segment. We will have a broad overview of this entire derivative segment, then we will discuss this futures specifically. See, the derivatives, you have three instruments to be discussed. One is futures, then there is options, then there is swaps. Three kind of instrument we are going to discuss. Here, in this chapter, we are going to cover equity futures and commodity futures mainly. See, what do you mean by derivatives? Derivatives are nothing but the instruments which derives its value from the underlying asset. So, underlying asset for equity instrument, the derivatives which are having equity instrument as underlying asset are called as equity derivatives. Are you listening? So, equity futures and commodity futures, okay, we are going to discuss in this first segment. Then we will discuss options chapter. There we will discuss equity options. Are you listening? The interest rate futures, interest rate options and guarantee and interest rate swaps we will discuss under interest rate risk management. These are also derivative instruments, but we will discuss under interest rate risk management chapter. Are you listening? Okay. Currency futures, currency options comes under forex chapter because underlying asset is currency, na? Foreign currency. So we will discuss under the institute has given you these two chapters under these two topics under forex chapter. What we will do is that we will discuss separately currency options and currency futures. Okay, we have a separate chapter, we have a separate topic we will discuss. Then we have currency swaps. I will put a separate video. Are you all understanding? Currency swap we will discuss separately. Now we want to discuss equity futures and commodity futures in this segment, derivative segment. Are you listening? So shall we start? See here, what are the learning objectives in this futures chapter? First we will learn the basics of the futures. Then we will learn about margin account and MTM procedure. Then we will learn fair futures price. Okay, and in that we will learn cost to carry model. Then we have arbitrage in futures, correct? Imperfect futures pricing, arbitrage opportunity, we will discuss about that. Okay, then there is hedging through futures. So predominantly 5 or 6 topics only are there in futures segment. Okay, comparatively small segment only. So shall we start? Okay, see here. First, basics in futures. Basics, we have few terminologies. We will understand all these things. Then we will move on to the other topics. See, first you need to understand what is the difference between cash market and futures market. See, cash market and futures market, types of market. We have cash market and futures market, or you can also say it as cash segment and futures segment. See, cash segment is a place where you buy and sell the underlying asset. Here equity futures, you have the underlying asset as equity shares. Equity shares and where equity shares are bought and sold are called as cash market. See here, the asset price is quoted by the cash market is also called as spot price. Now let us take an example and understand all these things. See here, first Mr. X buys 2 March TCS futures contract as rupees 2020 on 13/5/25 on 26/3/25. Okay, this is contract expiry date. The futures closed at 2050 and 2000. Share is quoted in the stock market today at rupees 2009. This is the example given. Are you listening? So this is the quotation from the futures market from both these markets. So cash market I have a quotation. Share is quoted in the cash segment at rupees 2009. This is not year, rupees. Okay, this is year rupees 2009. Now the futures market today, assume today is 13/3/25 and today the futures market price quoted for the what is that ITC futures TCS futures is 2020. Assume TCS futures price is 2020. This is the quotation given. Now we will understand through this example all these terminologies we will try to understand. Shall we start? See here. Cash market is a place where the asset price is quoted, which means here as underlying asset is TCS shares. TCS shares is quoted in the spot market. What if you want to buy TCS shares? I told you in the equity segment, screener website and all, I told you where to get the share price. There if you see the share price, if you want to buy the share, it will be quoted in the cash segment, that is 2009. If you spend 2009 rupees, you will get 1 share of TCS in the spot market, or it is called as cash segment or cash market. Are you listening? Now come to futures market. Futures market, the price is quoted today. Assume 13/3 is today. Okay, and the quoted price is there now 2020. This is the price quoted, okay, today, but for a transaction to be taken place on the future date. Are you listening? This 2020, what do you mean by this 2020? Futures are nothing but a contract, okay, which is agreed upon today for a future date, which means the price is agreed upon today for a future date 2025, which means I want to buy, if you buy TCS futures today, what it implies na, okay, you are agreeing to buy TCS shares, underlying shares, today or tomorrow. Today you are agreeing to buy, but when are you going to buy? On a given future date, that is 26/3/25, contract maturity period. Okay, on the maturity date, I want to buy this TCS shares, but today itself I am agreeing for the price to be bought at. Are you listening? So 2020 is the price at which I am going to buy this TCS shares. The price quoted is a forward price. Futures price of 2020 indicates that we can buy or sell TCS shares on 26/3/25, that is contract maturity date, at rupees 2020 agreed price. Today itself we are locking in a price for a future transaction. Are you listening? This is very important. You need to understand the difference between cash market and futures market. Listening? Say types of position in the futures. See, very simple. We have two types of position: buy position or sell sell position. Buy position, it is also called as long, and sell position is also called as short position. Listening? Market terminology is very simple. Okay. If Mr. X takes a long futures position, what is the understanding? He has agreed to buy TCS shares on 26/3/25 for rupees 2020. If he is short TCS, if he is taking sell position, okay, in the TCS shares, what TCS futures, what it implies? Okay, he has agreed to sell TCS shares not today but on 26/3/25. Okay, but the price is agreed today itself. The 2020 price is agreed today itself. This is the understanding. Types of position, long and sell shares. Now come to expiry date. See, and also one more thing I wanted to clarify. Here you are buying and selling. If you have bought futures, suppose if you have bought futures at 2020, while selling futures on the maturity day, you will give a counter sell. Okay, how do you sell, close the futures position? If you have taken buy position, you will give a counter sell and close the position. Listening? When you give a counter position, okay, the price of futures prevailing on that date, you will consider and close the position. Even though we will try to understand that the on a given future date, on maturity date, okay, the price will converge. The spot market price or the cash market price, okay, the asset price and the futures price will be one and same. Are you listening? This is called as concept of convergence, which we will discuss later just to, okay, clarify. Okay, next, expiry date. Very simple. At any given point of time in the market, if you see, we have three futures available. That is, if you go today in the March, you are going now, okay, there will be three futures, March futures, okay, then there will be April futures and May futures in the Indian market. Are you listening? So three futures, 1 month future contract will be there, 2 month futures will be trading, 3 months future will be trading. Now assume if you are standing on the last day of current month, the last trading day, if you see the futures will be closed every month, it will be closed in the last Thursday. Okay, last trading day will be there, not trading day, last Thursday. Okay, it should be trading. If it is holiday, it will be 1 day before that day. Are you listening? Okay, so for example, I have a quotation here. I will show you that. Okay, see here. Can you see this? And taken from NSE website. Okay, see here. We have HDFC Bank, HDFC Bank derivatives. We have futures here, stock futures. If you see, the date is given as 27, as on 27 June. If you see on 27 June, okay, there is a July contract because already June contract would have been expired. So there is July contract is created. One is July contract, August, September contract. Three different contracts is there. 1 month future, 2 month future, and 3 months future. Are you listening? Okay, this is what I wanted to clarify. See here. Okay. If you are standing on 13th March, assume this is middle of the month, so March future would not have ended. There will be three TCS futures, March futures, April futures, and May futures. Okay, once the future contract expires, then what happens? Next trading day, another contract of the 3 month cycle will be created. Are you listening? Which means March, if you are standing on the end of the March, okay. Now March futures will be gone, yes. Then, okay, separately, April, May, the June futures will be created. Are you listening? New 3 months futures will be created, and the earlier 2 months futures will be 1 month future, and the 3 months future would have become 2 months future. 3 months futures would have become 2 months future. Are you listening? So this is the cycle. Okay, once the future contract expires, then on the next trading day, another contract with 3 month cycle is created, and the remaining 2 will become 2 months and 1 month contract. For example, when March futures expire, it will be replaced by June futures, and we can see 3 futures, namely April, May and June futures. This is all about basic understanding of the futures market. Are you understanding? Next, shall I proceed? Standardized contract size. Come to standardized contracts. See, futures will be always traded in lots. Lots in the same. In the cash market, if you want to buy one TCS share, the underlying asset is shares, na? Up TCS shares, one TCS shares, can you buy? Exactly, you can buy. If you see in the US market and all, you can even buy fraction of shares. That 0.5 shares, 0.2 shares also you can buy. Here, it is fractions are not allowed in Indian markets, but if you see, you can buy one TCS share. But if you see the futures, the underlying asset is contract is for the TCS shares only. For a future date, you are agreeing the price today itself, and the shares will not be okay for 1 share, 2 share and all. You cannot go and enter into futures market. Whenever you are entering into futures market, okay, it will be only traded in lots, which means there will be a standardized contract size. If you see, TCS has at present a contract size of 175 shares, which means if you want to enter into futures market, it will be entered into as a bulk only. 175 shares you can enter into a contract. Are you listening? Okay, 2 contracts in the example. The first example, we learned that Mr. X buy 2 March TCS futures contract. One future contract will have underlying, how many underlying shares? 175 shares. A lot size in a standardized size is what? 175. Exchange will fix the size. You don't worry. Okay, roughly around 7 lakhs at present. It was 1 lakh value, 2 lakh value. Now it is 7 lakh value. Are you understanding? Roughly on an average, for 7 lakh TCS share price is around 4,000. Based on underlying share price, they will fix based on the value of the transaction, they will fix the lot size. At present, there is 175 lot. Now, what you should understand, 2 March TCS futures. Now, the contract is for 350 shares, cumulatively for 350 shares. Apo Mr. X agrees to buy, 350 TCS shares, today itself for transaction to take place on 26th March at 2020. Are you understanding? He is agreeing to buy 350 shares. Instead of 2 future contracts, I can also say just 350 shares. Are you understanding? This is the standardized contract type. Normally, in the absence of any information in the question, we can assume that contract size to be 100 shares. Sometimes what happens, futures and all, contract size would be given. Don't worry about that. But sometimes in the option segment, when we are going to study, there questions they will not sometimes mention the lot size. By default, you should assume that it is 100 shares. But lot size is 100. In this example, Mr. X agreed to buy 250, 350. 175 shares, 175 into 350 TCS shares, 2 contracts at rupees 2020 per share on 26/3/25 on a future date. Settlement on maturity date. See, how settlement happens in futures contract, we need to understand. In the cash segment, first, whenever you are buying, say assume the TCS futures is quoted at 4,000. If you pay 4,000 rupees, you will get the delivery of the share. This is called as delivery of the shares. What do you mean by delivery of the shares? The shares will be credited to your demat account. Are you listening? In case of futures transaction, what will happen? You are agreeing to buy on a future data. What will happen on 26th March? Assume you are holding the futures till 26th March. On 26th March, you are agreeing to buy. Will you require to pay this amount and take the delivery of the shares? No need. Are you understanding? In the futures market, actual delivery will not happen. Generally speaking, SEBI, 2018, SEBI has come up with notification to avoid some speculative activity. I'll discuss about that later. Are you listening? I'll just clarify that, no issues. But understand that generally the index futures and all, delivery happens by way of, the settlement happens by way of net cash settlement will happen. Are you listening? Cash settlement will happen. There will be no, now you are agreeing to buy at some rate 2020. Assume on 26th March the futures price is quoting at futures price is quoting at 2050. You bought at 2020. You will sell at 2050, which means profit of 30 rupees is there. This will be credited to your margin account and will be settled. Net settlement will happen, and the profit or loss will be debited or credited to your demat account and margin account, and not the actual delivery of the shares. You will not either take delivery, or if you are selling, you will not give the sell the shares. Are you listening what I am trying to say? You need not have the shares. until recent times. So generally there will be no actual delivery. Cash segment delivery will happen. Okay, in the future segment there will be no actual delivery. Are you all listening? The contracts will be cash settled, net settled. Say until recent times, trading in equity futures and options was cash settled in India. What this means is that upon expiry of the contract, buyers or sellers had to settle their position in cash, which means you are agreeing to buy up 350 shares you have agreed to buy. On that date, assume the share price is some 4,000. This you need to pay on the date of maturity and get the settlement done. Are you listening? Delivery, you have to take the delivery of the shares, physical delivery of the shares. This was the position, net settlement was the position earlier. Then, okay, the exchange decided that too much speculative activity may happen, so they are to curb the speculative activity in the future segment. They decided that to some extent. Why is that? Futures you only need to pay margin and start trading. Unlike the equity segment or cash segment, you need to pay. Suppose TCS shares is quoted at 4,000. Entire 4,000 you need to pay and buy the get the delivery of the shares. Are you listening? But in futures market, what you should do you can do you only have to pay the margin amount. Say it will be 15-20% around something. The exchange will fix the margin. Okay, there will be some, it will analyze based on the volatility of the stock, individual stocks. They will fix the margin for these. There is a software called as SPAN. Okay, standard portfolio analysis. Using that, okay, it will analyze the using the VAR technique, value at risk technique. Okay, it will analyze the risk of this security and then fix the margin amount. Okay, that you have to deposit and you can start trading on the underlying asset. Are you listening? So futures, if you want to trade, you can deposit only the margin amount and can trade. No need to deposit the full amount and trade. Are you listening what I'm trying to say? For example, 350 we discussed now, 175 is the lot size of TCS. Assume 350 is the total 2 contracts you are buying in the futures market. Up 350 into, say it is for, 2020, assume 4,000 some amount, futures price. Up 350 into 4,000, how much is that? 350 into 4,000. Okay, it is coming to 14 lakhs. Up only when you are having 14 lakhs you can trade. No need. 14 lakhs out of this, okay, say 20% is a margin money. With just 2,80,000, 2.8 lakhs having in your margin account, okay, you can start trading in the futures market. Are you understanding? Leverage, okay, this is why we call it as leverage market. Are you understanding? Say, on April 1, 2018, SEBI released a circular making physical delivery of stocks for all F&O contracts mandatory in a phased manner, which means not entirely implemented, but phase by phase they are trying to implement almost. Okay, the aim was to curb excessive speculation, which would result too much volatility in individual stocks. Are you listening? All these things. So, tell me children, what will happen in case of settlement? Now come back to the futures discussion. Settlement will happen. We will assume that, okay, settlement may happen. In the commodity, except for commodity futures and all, settlement will generally happen through net cash. Are you listening? Which means the profit or loss will be credited. In the questions also, if you solve in the futures, if you see in the futures ICAI questions, you need to, you can solve either by taking delivery also, that is not an issue, but you will assume that it is net cash settled and solve the question. Are you listening? Sorry. Buy futures is closed by the exchange through counter sell and sell futures closed through counter buy, which means, see here, if you have taken a buy position in the futures market, okay, how to close the contract? If you want to close the contract, okay, what do? You will counter sell. Are you listening? If you have given buy, if you have taken buy position, to close the position, you will counter sell. If you have taken the short sell, if you have taken short position in the futures first, then what you will do to close the position? If you will take a counter buy position and close the futures market. Are you understand the futures position? See here, futures contract closed at 2050, futures contract closed at 2000. First, we bought the futures, okay, we agreed to buy the TCS futures at 2020 initial on 13/3, correct? On 26/3, assume the futures is quoting at 2050, case 1, this is case 1, this is case 2. Which means if 2050 is the quoted price, futures price on the date of maturity, what will happen? You have bought futures at 2020, you are selling futures at 2050, 30 rupees you have made a profit. Are you listening? Conversely, if you have bought futures at 2020, okay, and if you are selling futures at 2000, what will happen? You are incurring loss of rupees 20. The contract is closed by booking profit or loss. Next, can we exit? This is how settlement happens. Net cash settlement will happen. Are you listening? Delivery, nothing but pay the entire amount and take delivery. That's the only difference. Are you listening? Can we exit before maturity data? Yes, of course. See, today is 13th March. You have agreed to buy TCS whenever you are buying the instrument. See, futures market will be created by the investors only. Correct? Okay, they will create the quotation. If someone is there in the other side, the matching will happen, exchange will match these contracts and the contract will be executed. Are you listening? But is there any obligation that you need to hold the security till, hold this futures till maturity data? No need. If you want to sell in between, you can sell the contract as such in between and close your position. Are you understanding? Today is 13th March. Say if you are unhappy with the movement of this futures, 20th March you want to close out the position. 13th March you initially entered the contract. Okay, after 1 week, assume the share prices keep falling. So when the share price is falling, futures price will also correspondingly fall. Not at the same rate, but it will also react similar to cash segment price, which means TCS shares price is falling. TCS futures price will also fall. Not at the same rate, but it will keep on falling. If it is falling, you have bought at 2020, assume by 23, okay, the TCS price has fallen to say 1990, okay, 1990. Assume you are incurring loss of some 30 rupees or something. Are you listening? So in that case, I am feeling that there is continuous loss. On 26th March, I am feeling that instead of going to 2050, it may even drop to 1800. I am fearful of that. Are you listening? In that case, what I will do? I can close the position today itself or not, or I have to wait till maturity. No. In the futures contract, you can even exit before the maturity. That you need to understand. Yes, we have bought futures now. We can exit by given counter sell. Apo, if you have bought futures at 2020, you can counter sell. You have bought now. You can counter sell at 1990, and then you can book loss of 30 rupees and get out. You don't need to wait till maturity to get out of the contract. So how it will be executed? Sir, I have entered into contract. How will you execute? No, don't worry. Some other person may may want to buy the contract. We have sold this at 2019. Are you listening? Some other person may wish to buy the contract and continue the contract. The contract will continue. Are you understanding? Okay, this is what I wanted to clarify. Say the counterparty will replace our position, the other party will replace our position and continue the contract. More about this seen through open interest discussion. There I will discuss how really the transaction is a relay race. If you want to close in between, you can throw it to some other person. Okay, he will continue the contract till the maturity if he wishes. If he wishes to throw it out in between, he can also throw it. Relay race. Okay, you don't need to hold it till maturity. Next, concept of index futures. See here, till now I discussed about TCS futures, how profit and loss will happen, all these things we discussed. Now, there is a concept of index futures. What do you mean by index futures? Very simple here. Okay, in the example also I have shown you. Can you see this? This is a quotation for index. See, in the equity valuation segment, like I told you, index is not points. If you see the individual TCS shares, the TCS futures and options are derived from TCS shares. Underlying asset is TCS shares. Nifty futures, like this, there is Nifty futures and Nifty options. There, the underlying asset is nothing here. Nifty, are you listening? This is just points. Nifty is not some shares or something. Are you listening? Nifty is a company, it's just points. So, Nifty points, derivative instruments there is no cash market available for the Nifty. Listening what I am trying to say? In Nifty based index funds are there. That is not what I wanted to clarify. Now the point is, for derivative instruments, you need underlying asset. For that Nifty underlying asset, something Nifty is something like share. There is nothing called as Nifty. Are you listening what I am trying to say? So, only we have futures market and options market, which derives the value from the underlying Nifty points. Are you listening? Index. See here, we have Nifty. Okay, here if you see, this is index derivatives. Okay, the stock derivative separately, index derivative, currency derivative, leave it. Currency derivative, we don't discuss at all in this segment. Index derivative, you see the quotation. See here, 8,800, this is an old quotation. I think now Nifty is around 25,000 per. Now this old quotation as on February 19, 2015. Old quotation just for clarification. See here, 8,854.7 is the futures quote, index futures quote. Okay, all these things are there. Data, traded volume is there, traded value. Okay, then there is value weighted average price, VWAP. Okay, then market lot. Can you see? At that time, okay, the index market lot was 25, which means index lot was 25. If you see on an average 8,800 into 25 would come to 2,20,000, around 2 lakhs at that time. Now the lot size has increased. Okay, that is also there. Now you see There is open interest, we will study later, no issues. Okay, see the order book. We have buy quantity, buy price, selling quantity and sell price. Are you listening? Either previous close is there, open, high, low, okay, the closing price. Now it has not closed now. So this live quotation, market, see here, 12.56, so market closes at around 3:30. So it has not yet closed, and closing price not given. Assume this is the closing price. Assume this is the closing price, which means this 8,854.7 is there now. This is a quotation for index futures. Are you understanding? This is the index future. Inge paru 26 February, the expiry date is given clearly. Are you all seeing? 26 February is the expiry date given. Nifty futures given. Are you listening? So this is all about Nifty futures. See, there exists spot market for stock, currencies, commodities, etc. We can buy and sell all these underlying assets in spot because they can be delivered. But okay, even though there is spot, Nifty is there, Nifty. But Nifty is not delivery, it's just a point. Deliverable, there is nothing deliverable. Are you understanding? They cannot be bought and sold in spot because they are just index points and not deliverable. We have seen that in futures market, contracts are cash settled and there is no need for delivery of the underlying. Even we can create futures contract on indexes underlying. See, the derivative contract, can it be created on points? Yes, very much possible. Are you listening? Derivative contract can be created on anything and everything. No joke, there are electricity derivatives. Okay, if you see there are commodity like crude oil derivatives, wheat derivatives, rice derivatives, everything is available. Are you understanding? Derivatives can be created on anything and everything. Okay, it is just a betting. Okay, based on speculative aspect, anyone can create contract on anything and everything. Are you listening? Said the contract is settled by booking P&L based on index movements. How P&L will be settled? Based on index movements, it will be settled. Whether you are incurring loss or profit, it will be settled through the movement of the index points. These index futures are very popular to hedge a systematic risk through beta hedging strategies, which will be discussed in the later part of this chapter. See, in the last segment, the futures, beta hedging is that concept of beta hedging. What do you mean by that? If you take exposure in the stock futures, if you take exposure in the cash segment, equity shares, assume you have bought TCS shares. Are you listening? There are two ways of hedging this. Either you can hedge through TCS futures, same futures, okay, which has the underlying asset as TCS shares, or you can hedge through the index futures, the concept of index futures. There is something called as beta hedging to reduce the market risk, okay, to reduce the systematic risk or to manage the systematic risk. We can take position in index futures. Are you understanding how this will be taken, how it will be hedging our cash market position? This we will understand through various examples in the last segment of this chapter. Are you listening? There I will explain it. Now understand that there is two different futures market. Adavadu equity futures you have individual stock futures available, then we have index futures. Individual, why we have want index futures? I will tell you. Stock futures are only available for famous stocks. Okay, there are some companies only have equity futures for them. So Infosys futures, TCS futures, like this, few companies have futures. But if you see a lot of companies, small cap companies and all, or mid cap companies and all, they don't have futures market at all. In that case, there are 5,500 odd listed companies in the BSE. Are you listening? So in that case, all the companies won't have futures market. So how to hedge our position in the cash market? We can hedge through beta hedging or index futures. We can hedge. This is why we are going to discuss everything later. Are you listening? Understood the basics of all these basics of the futures market? Basics you understood. Shall I proceed? Okay. Next, we'll move on to the MTM procedure and margin account. Now see, as I already told you, what are these margin accounts you need to understand? See, if you open the Demat account, there will be two segments. F&O segment, I told you, the cash segment, and we know that we have two segments. Cash segment, we will buy and sell the equity shares. F&O segment, we will enter into contract based on these equity shares, that is futures and options. Correct? Either when you want to trade, when you open in your Demat account, there itself, okay, there will be a margin account. Margin account, okay, where you have to deposit money. Are you understanding? Where you have to deposit money in order to take positions or trade. Are you listening? So when you want to buy shares alone, up equity segment, like cash segment, when you buy and sell shares, when you want to buy and sell shares, you want to deposit the entire amount, or if I can say margin account, like you have 2 lakh rupees. Assume in the margin account you have 2 lakh rupees. Now, you can buy shares worth 2 lakh rupees. Are you listening? But futures, you only need to deposit only some percentage of your total money. Are you understanding? You don't need to okay, spend entire 2 lakh to buy the 2 lakh worth futures. Are you listening? To put it simply, in a value in the quotation I showed you, here, see here, the traded value is there. Can you see this? Is it visible? Okay, see here, if you carefully observe, there is traded value of 5 lakh, what is that, 58,000 or some number. 5 lakh 58,000 is there, na? This value, okay, is of the total value, not only of the margin value. To put it simply, assume, now I will say, TCS price is 4,000. TCS futures is 4,000. Lot size is assume 175. Are you listening? Up 175 into 4,000 is around roughly 7 lakh. Are you listening? This is the total value. Listening what I am trying to say. Okay, this is in lakhs. Yes, this is in lakhs. 5 lakh 58,000 lakhs. This is just 7 lakhs. Now, this is the value which this is referring to. Listening. But whether you need to deposit the entire 7 lakhs to trade in futures to the extent of this value? No. Okay. What we can do is that assume the margin will be there. It will be fixed. It says 25% margin is there. Which means 7 lakh, 25% is how much? 1,75,000. If you deposit only 1,75,000, that is enough. If you deposit only 1,75,000 in your margin account, that is enough to trade in the futures to the extent of 7 lakhs. Are you listening what I am trying to say? So this is all about margin account. Margin account, what do you need to understand? If you want to buy and sell the shares, 7 lakh entire amount you need to deposit. If you want to trade in futures, you only need to have some percentage of whatever is fixed by the exchange, you need to have the balance. Listening, this is called as initial margin. Initially, whatever is the requirement, okay, in the question and all, it will be given. The practical scenario, the software will compute all this and give you. Are you listening? This is all about initial margin. This is about initial margin, which means the amount which you need to deposit initially to start trading in respective futures, index futures or stock futures, that is called as initial margin. Now the point is, what will happen once you start trading, every day, okay, you will have MTM. In the market, there is a unique procedure called as MTM procedure, mark to market procedure. You will learn in FR also, derivative financial instruments chapter. There you will use MTM procedure. Every day, the exchange closing date is there. You will consider, even though your position is open, assume today 13/3, you have bought the futures and the maturity date of the futures is 26/6, last 26/3, assume 26 March is the expiry date, correct? Now, even though every day you have not sold the futures or you have not closed the position, every day it is assumed that you are closing the position. Are you understanding? Exchange will assume that you are closing the position. So, okay, it will close the position on the day end. Again, it will be reopened on the next day. Are you listening? It will be marked to market at the end of closing price. Are you listening? At the last 30 hours, VWAP price will be considered in order to avoid the price rigging and all. They will fix the VWAP. Another VWAP given. Okay, all these things I don't want to discuss in the revision segment. In the regular lecture, we discuss all these things. I don't want to discuss all these things in the revision lecture. Understand that margin account, whatever we deposit, okay, what happens? Daily settlement will happen, which means the settlement will really happen daily, on a daily basis. Whenever the price is fluctuating on a daily basis, the P&L will be keep on changing. Are you understanding? If you are incurring loss at the end of the first day, your margin account will be reduced to that extent, will be debited to that extent. Are you listening? If there is any profit, it will be credited. Like that, the margin account will keep on fluctuating, and if the margin account breaches certain limit, this is called as, okay, maintenance margin, which means always you should have the margin to top up balance money. Okay, it is like recharge when you recharge your prepaid mobile, okay, when you put the amount, what do you do? Okay, when it breaches certain amount, okay, they won't wait till the expiry. Are you listening? When it breaches some amount, they will call you or message that the balance is too low, recharge, or the date is coming near, okay, within 3 days the plan is going to expire, recharge or same way. Here also there is the concept called as maintenance margin. So assume you have deposited initially 12,000 rupees. This is initial margin. There are 3 types of margin. I am explaining different types of margin account. Are you listening? Margin account, there is initial margin, okay, there is maintenance margin, and there is variation margin. See here, initial margin, see here, 3 margin accounts I have given. Yes, I have given in the notes also. See here. First I will explain and then I will read out the notes. Initial margin, assume that today you are depositing 12,000 rupees and started trading. What happens? Every day M2M procedure is there, you are incurring slowly losses, and okay, the maintenance margin is fixed at 8,000 rupees, which means If the price is going below 8,000, if the margin balance is like something like bank balance, from bank account it will be connected to your demat and the funds will be uploaded margin to your margin account. Are you listening? When you are incurring continuous losses, even if the position is open, if you are incurring losses and the balance is getting reduced, if it is getting reduced below 8,000, this is called as variation margin. This is not variation margin, this is maintenance margin. Maintenance margin. In the maintenance margin should be at least 8,000. Exchange has fixed that. If it goes below the maintenance margin, what you have to do now? You have to top up. Just like before you top up now, like that you have to top up and you have to bring the balance back to the initial margin, not the maintenance margin. For example, 8,000 is there now. Today you incur 2,000 rupees loss and the balance comes to 7,000. From 9,000 it was there 9,000 balance and then 2,000 rupees loss you are incurring, it came to 7,000. Now you want to top up now. Will you top up just 1,000 rupees? Not enough. Not enough. You have to bring it back to initial margin. Are you understanding? So 7,000 and 12,000 you need to recharge back. 5,000 rupees you need to put. This is called as variation margin. The amount of margin which you require to top up to make good the initial margin is called as variation margin. When will you top up? When it goes below the maintenance margin. Are you understanding 3 different margin accounts? Shall I proceed? See here. In every futures contract, the counterparty is stock exchange. That we know. Futures contract, the counterparty will be stock exchange because stock exchange is the facilitator. Matrimony website, Mary. Are you understanding? The other person who is buying, or selling is not of your concern. You will, open a contract. And the other person, if he is willing to buy, the exchange will, will send your contract to him. Are you understanding? It will match your contract. So the counterparty is stock exchange only for all these transactions. For example, Mr. A is long, Mr. B is short. For both, the counterparty is stock exchange. They don't need to know themselves. Are you listening? They don't need to know each other. Technically speaking, the stock exchange does not have risk because it is having offsetting positions. However, there is always a chance that party making loss may default. Are you listening? So there is always a default risk, which means you are trading with margin account. You only need to deposit 12,000 rupees for a transaction of 1 lakh rupees. Assume correct. Only 1/4 you need to deposit as margin. Tomorrow, if you are continuously incurring losses, then you may run away. Are you understanding? That's why initially they want to a prepaid account. Initially they want you to deposit some money and then start trading. Then if you incur some losses or if your margin is down, they want you to bring it back. Are you listening? To trade further. Otherwise, exchange will throw you and close the position. Are you listening? Sorry. However, there is a chance that the party will default, exposing the exchange to counterparty risk. To avoid the counterparty risk, the exchange requires both the party to deposit margin money and then start trading in the futures. The exchange books P&L based on MTM procedure. The futures contract gets settled each day at the end of settlement price and reopens the next day at the end price. Are you listening? The closing price which you are taken today will be the opening price for the tomorrow. Are you listening? And that will be the opening price and then everyday settlement will happen. The P&L is booked on the respective parties' margin accounts on daily basis. Money will be transferred from the margin account to the party which has suffered loss during the day to the margin account of the party which has made a gain. What happens when a person continuously books loss in the margin account? See, margin call will be made to him asking him to deposit sufficient money in the margin account to keep his contract alive. If he fails to deposit the sum, the contract will be closed. See here, now I will explain what are the ways in which a futures contract may get closed. 3 ways in which futures contract may get closed. There is a voluntary closure by the party by giving a counter buy also by exiting his future to his existing futures position. Very simple. I told you futures contract can be closed even in between the maturity date. Agreed or not? So in that case, what may happen? Whether you can buy or sell in between, yes, you can close the position. If you close the position voluntarily, it is called as voluntary closure. Are you understanding? Futures contract may be closed voluntary also. And exchange may also close the position. When you have insufficient funds in the margin account. When you have no balance to further trade, they may throw out of the contract. Are you listening? That is possible. The third option is that maturity date you are not closing the contract in between, you are holding till maturity. Maturity date automatically the contracts will get closed. Closure by the exchange itself when the contract reaches its maturity date. Are you understanding? This is natural. If you hold till maturity, this will happen. If you don't roll over before the specified period, it will close it. That is closure by the exchange when the contract reaches its maturity date. Then there is voluntary closure and there is closure by the exchange when there is insufficient funds. This is important. Are you listening? The exchange decides the margin money on the futures contract based on volatility of the underlying asset prices. Everything I have discussed briefly. I have just given notes also, you can go through. This is measured through VAR. Okay, these are calculated using software called as PAN. Types of margin, this is the important aspect. Come to this. Initial margin, maintenance margin and variation margin. Initial margin is the amount to be deposited initially at the time of taking the position in the futures market. Okay, this I told you. Maintenance margin is when the margin account balance goes below maintenance margin. This is the margin. Okay, the minimum amount you have to always keep in your margin account. The balance you should hold in your margin account. Okay, if that breaches, you have to recharge. The exchange will make a margin call requiring the party to deposit funds to bring it back to the initial margin. This is very, very important. I have seen students making mistakes here. It should bring back to initial margin. You should bring back the funds to initial margin. While doing questions, you should not just make good the maintenance margin. You should bring it back to initial margin. We have questions, 3 or 4 questions we will do in this segment. We will understand fully. It is the amount to be deposited in the margin account when the exchange makes margin call. Variation margin is equal to initial margin minus balance in the margin account when the margin call is made. Are you listening? For example, if you have 12,000 rupees as initial margin and your balance breached the 8,000 maintenance margin and the balance is only 7,000, which means how much you need to bring. So 12,000 minus 7,000 is there now, the 5,000 which you need to make good. This is called as variation margin. Are you listening? This is variation margin. Now initial margin, we have a formula specifically given in the this is mu plus 3 into standard deviation. This is nothing but daily absolute change. This is also called as daily absolute change. Delta change. This is standard deviation, 3 into standard deviation. Are you listening? So based on the stock volatility, they are fixing this na. Sometimes question what will it? If question nothing mentioned in the question, they have given the value for mu, the value for standard deviation. If it is given in the question, you will take this and solve this. Are you listening? If this is not given and straight away they have given the value, they have assumed that 25% of the contract value, total contract value, straight away they have given that 25% assume ad hoc basis. They may give in the question 25% assume that this is the initial margin amount. Whatever question specify, do as per the question's requirement. Are you all understanding? Generally, practically speaking, software takes care of all these things. But in the question, if asked specifically, you should do like this. Sometimes a note also I have given. Can you see this? Sometimes questions will say a percentage of total contract is to be taken as initial margin, and for maintenance margin also question will mention the calculation to be done. In these cases, just do as per the question's requirement. Shall we do some questions in this regard quickly? Within 5 minutes we can solve this. See, on November 15, when the spot price of telco shares is 473 per share, Mr. X buys 15 contracts of July telco futures at 491. Are you listening what I am trying to say? In the quotation, you should have the maturity now that the telco share, this is spot price, which means to market na. In the cash segment, the equity shares of the telco is quoting at 473. The future segment, this is the futures, July futures is quoted in the futures market at 491. Please tell me, children, which price you will consider for MTM calculation? Futures price, not spot price. Are you listening? Very important. That's why I try to differentiate the cash market and futures market. This is the difference. Are you understanding? This is given for just to confusing you. Say futures 491 only you should be considering. There. Next, assume that the initial margin for telco futures is 800 per contract. They specifically given initial margin should be taken as rupees 800 per contract, not per share. That also you need to carefully observe. And then maintenance margin is rupees 600 per contract. Given that each contract is 50 shares, daily settlement prices for the next few days are as follows. See here, these are all daily settlement. Now November 15, closing price is 496, then 16, 17, 18, 19 given prices given. Assume that Mr. X withdraws profit from his margin account only once on November 16th when he withdraws half the maximum amount allowed. Compute the balance in the account at the end of each of these 5 days. This is a question that is being asked. Shall we start solving? If you are listening to this video, take a minute time to read the question, then start solving. Are you listening? See here, very simple. 15th I am starting the transaction. Buy price is what I told you. 491 is relevant and 473. First observation. Are you listening? So I'll take buy price as 491. Then sell price, you are not selling the futures on that same day. Are you listening? Sell Okay, the MTM procedure, it is understood that it will close the position. Closing. Are you listening? Closing. Okay. On the first day, November 15, what is the closing price? 496. When you close at 496, what is the P&L? 3750. How you arrived at 3750? Very simple. You see 496 and 491. What is the difference between that? See here, 5 rupees. Okay. This is per share. 5 rupees is the profit per share. Are you listening? This is the profit per share. How many shares are there? Okay, by 15 contracts. Are you listening? So 15 contracts is there, and each contract is 50 shares. Listening what I am trying to say, he is trading 15 contracts. Okay, and each contract is 50 shares. 15 into 50 into, what is the P&L profit per share? Okay, this is profit per share. Listening, 750 into, how much is that? 750 into 5. 750 into 5, 3750. Are you understanding how they got this? Okay, that is a P&L for the first day. Opening balance 12,000. They have given that. How they computed? Very simple. 800 is the 800 is per contract initial margin price. How many contracts? 15. 15 into 800, 12,000 is the total margin. Initial margin, opening balance is 12,000. P&L is 3750. Correct? Closing balance 15750. This is the end of the first day story. Second day, opening at 496, the previous day closing, and selling at 503. Are you understanding what I am trying to say? You tell me whether profit or loss per share. Yes, profit per share is how much? 503 minus 496. How much is that? 7 rupee per share into 15 contracts into 50 shares per contract, which is 5250. This is the profit. Are you listening? Total 15750. Opening balance 15750. Further profit 5250. Correct? 15750 plus 5250 should be the total amount balance 21,000. Correct? But in the 21,000, there is one adjustment. They have told that assume Mr. X withdraws profit from in margin account only once on November 16th. Correct? Okay. Whenever they are asking about withdrawal, at the end of the day only you will withdraw. Are you understanding? Then only you know the accurate balance. You should not withdraw even below the margin. That is why they have specifically mentioned. Say, when he withdraws half the maximum amount allowed. You tell me, what is the maximum amount allowed? See, I told you, whenever you are withdrawing, there is a catch here. Whenever you are withdrawing funds from margin account, you should not withdraw below the initial margin. For example, now your balance is 21,000. How much maximum you can withdraw? See, initial margin is 12,000. Only till 12,000. Upon 9,000 only can maximum withdraw. You can only maximum withdraw 9,000 rupees. Okay. One more thing is that, but the balance, can it go below 12,000? Yes, it can go below 12,000 by way of MTM procedure. Now the MTM, by way of MTM procedure, it can go even below the 12,000 balance. Are you listening? For example, say the balance is 10,000. Okay, is it possible? MTM loss you are incurring 2 days, 1,000 you are loss, incurring the loss, and balance is 10,000. Which means, is it possible to go beyond below the initial margin? Of course, yes. But it should not be by way of withdrawal. When you are withdrawing, you can only maximum withdraw till initial margin. But by way of market transaction, okay, you have not closed your futures position. By way of market fluctuation, okay, it goes below the initial margin, but it doesn't go below the maintenance margin. In that case, it is possible. It is fine. Yes, it is perfectly fine. Are you listening? So come back to the question. 9,000 is the possible maximum possible. What he does, half the amount he withdraws. Up to 4,500 he withdraws. Balance is 16,500. Again 17th. This is the point. This is the loss he is incurring 11,250. Now 16,500 was the balance. From there 11,250 is getting reduced. In that case, what is the balance? Please tell me. Here, see, I'll tell you. 16,500. Okay, minus, how much is the loss? Today's loss, 11,250. How much is the balance? 5,250. Now you tell me, this is the most important adjustment in this question. 5,250, how much you should add back? How much you should top up? That is the question. Now you tell me, maintenance margin, see here, I will tell you, initial margin in this question, how much maintenance margin is, how much you need to see. Initial margin is 12,000, we know that, correct? Maintenance margin is how much in this question? 600 per contract, 600 into 15. How much is that? Please tell me. 9,000. Are you listening? Now the balance is how much? 16,000. 16,500 minus 11,250. How much is the balance? For 5,250, which is well below the maintenance margin. Now, what is the top up amount? You tell me how much money I should bring back. I should make good the initial margin, not the maintenance margin. You should not do 9,000 minus 5,250. You should do how much? 12,000 minus 5,250. You should bring 6,750. Are you listening? This is what is given here. 6,750. Are you listening? Okay. And you should make good the closing balance should always become the initial margin. Should make good the initial margin. So 12,000 is there. Again 488 it will start. From 488 it went again to 485. It goes again to 485. 2,250. Okay, you reduce from 12,000. Now you tell me from 12,000 minus 2,250. Is it going below initial margin? Yes, it is going below initial margin. The balance is 9,750. Are you listening? So in the 9,750, you need to top up or not? No need. No need to add any funds because it has not breached the 9,000. Only when maintenance margin is breached, you need to top up, and that too make good the initial margin. Are you understanding? So no need to do anything. 9,750 is the balance. Next day again incurring profit or loss or profit. So 4,500 will be increased. So 14,250. No adjustment is required. This is the solution for this question. Are you understanding how margin accounts are solved? Next question. Quickly we will move on. Sensex futures are traded in the multiple of 50. Okay, this is Nifty futures. Are you understanding? Sensex futures or Nifty futures. This is index futures. Previous futures, telco futures, stock futures. This is index futures. Consider the following quotations of Sensex futures in the 10 trading days during February. Okay, days given 4 to 5, 6, 7, all these days are given. Are you listening? Now, see here in this question, if you observe day, high, low, closing la given. What is relevant is closing date. What is relevant is closing day. These are all given to confuse you. All other the details are given to confuse you. Closing day is very important. Say, closing price is only important. Abhishek bought one Sensex futures contract February 4. The average daily absolute change. Are you listening? Now they have given to apply the formula. Okay, and the mu plus daily absolute change plus 3 into standard deviation. This you need to find now. For that only they have given all these details. The average daily absolute change mu is how much? Value in the value of the contract is 10,000. Listening, and standard deviation of these changes is 2,000. Upper 10,000 plus 2 into 3, 2,000, 3 into 2,000, which is 6,000. Upper 10,000 plus 16K is the initial margin they want you to, they are communicating. The maintenance margin is 75% of the initial margin. You are required to determine the daily balances in the margin account and payment of the margin calls, if any. See, I am speeding up the question answers to save some time for the concept discussion. Are you understanding? Don't think I am the right? Say. Because question answers you can easily solve by just a revision of the concept is only important. Okay, the few days before exam, understanding the concepts thoroughly is most important. Are you understanding? Questions it can be asked in many ways. Are you understanding? Same question can be twisted and turned. But if you are thorough with the concepts, you can easily solve the questions. Okay, so initial margin is mu plus 3 into absolute changes where daily absolute change, standard deviation. Okay, initial margin 16,000. Maintenance margin they have given us how much for 75% of the initial margin, which means 16,000 into 75%, 12,000. Listening, Now what you should do, now you will take each and every day and consider what is the margin money balance, how much you should add. See, initial margin 16,000 on 4-2. Okay, call money required or nothing is required. Next day, change in the futures price. If you observe all these data given for futures, are you understanding? This spot index, same just like your shares, you have spot index and the futures index price. Are you all understanding what I'm trying to say? There also the price, see, if underlying index points increases, the futures price will also increase, but are not the same rate. Are you listening? Okay, if I have time, in the regular lecture I show you how the variation happens, but you understand. Cash market how we saw in a similar way only, here also it happens. Index points need not be same as futures point. Here we need to consider only futures point. 3296 we will consider. Are you listening? Second day also 3296 we will consider and 3294.4 we will consider the difference. Are you listening? See here, 3294 is the closing minus the opening 3296.5, the balance minus 105. Are you understanding? Okay. Into this much rounding of issue, no issue. Decimal I have rounded off. So 15,895. Okay, this is the margin account. Are you understanding? Anything required? No need to add any funds. Why? Because maintenance margin is 12,000. I have the balance, requisite balance, so no need to add. Here also I don't need to add. I don't need to calculate also. This transaction 7th February. You see that. Okay, the difference is minus 905. Okay, the amount is 905. Now you see from 12,695, if I reduce minus 905, it is going below 12,000, the maintenance margin. But I need to add only till only 905, or I need to add till initial margin. Initial margin, I need to make good the initial margin. How much is that? 11,790 minus 16,000. Other 16,000 minus 11,070, that is 4,210. Are you understanding how the calculation is done? All these go through, I don't want to discuss further. Okay, here also the bridge you need to make good. Okay, margin account, the question given, different varieties of questions I am trying to cover. See here, the price of March Nifty futures on a particular day was 9,170. The minimum trading lot of Nifty futures is 50. The initial margin is 8% of the contract value. Three different positions. See, initial margin directly they have given some amount. That is possible in the question number 1. Secondly, the formula you have to apply. Sometimes when they give daily absolute change and standard deviation, you should apply the formula and find out. Third, this also they can give simply contract value, total contract value, some percentage they can ad hoc basis they can assign. 8% of the contract value is the initial margin, maintenance margin 6%. Are you listening? 6% of the contract value. Say the Nifty futures is closed on the day, last 5 day closing price Nifty futures, okay, index futures closing day given. Listening, this is just to show you contract value, how they can give the margin amount based on contract value. I am showing. Baki alla same, all other value, contract value first you need to find, right? This is the total value now into 8% you will do, that is initial margin, maintenance margin. Then the account will be same. Okay, day change in futures amount, margin account, call money. Are you understanding? This is amount changes in value. Whenever you are breaching this amount, okay, this is the 27,570 is the maintenance margin now, but 27,510 whenever is breached now, you will top up. Are you understanding? That you need to understand. You here also you can go through questions given simply. See, one more thing, here you need to understand. One thing is there. Yes, mark to market cash flows and daily closing background. An investor was taken long position, short position. Both they have asked. If you have taken long position now, you need to make a separate schedule. That's it. Here short position now you will first you have sold. That you need to understand. Okay, for an investor who had taken a long position, price appreciation will give you the profit. For an investor who has taken a short position, price depreciation, okay, will give you profit. Are you understanding? Same. Next, net profit or loss on each of these contracts that we will see. Okay, see here, long position if you have taken na, ending margin is 45,680, which means on the contract expiry date you have closing margin balance is how much pa? See here. The first for long position the balance was how much? 45,680. Can you see this number? Okay, this is the balance in the margin account if you take long position. That is the ending margin minus initial margin, the closing margin minus initial margin of 36,680. What is the profit amount? 9,000. Okay, less the margin call. How much is the margin call? 10,500, which you needed to deposit. So net profit or loss is 1,500. Are you understanding? Say. This 1,500 you can simply arrive at the closing last day prices also. If you can net it off, you will get the net profit or loss. Are you understanding? This net profit or loss only through various days you are getting. Are you understanding what I am trying to say? Say. Short position also you can go through simply ending margin, initial margin, you will get the profit. Then you have to make some margin call na. Okay, that is there. So profit is, net profit is 1,500. So yeah. Now okay, all this we discussed. Now we will discuss a concept called as open interest. Now we will discuss a concept, simple concept only. We will discuss briefly. One small question is there. We will do, the institute has not asked you questions regarding open interest and all, but we never know, okay, when they will ask. I'll tell you a classic example. See, we used to discuss in the class the concept called as convergence. Now the contango and backwardation, fair futures price. There is a concept called as, okay, convergence. When a maturity date, like I told you, the futures price and the spot price on the date of maturity will converge. Are you listening? The cash market price of the underlying asset and the futures price will be one and same. This is called as concept of convergence. This we used to discuss in the fair futures price discussion. Are you listening? I'm going to cover in the revision video. But the point is, till many years, institute, don't test these areas. Recently, in the RTP and one of the mock test paper, they have asked this RTP or mock test paper, I don't remember, but they have tested this concept. Are you listening? Contango market, what is backwardation market? Okay, backwardation market, how futures price will behave. Contango market, how futures price will behave. Are you listening? This I will explain. This they have tested. That's why we don't know what they will test. That's why I am covering also the concept of open interest. Shall I cover? Say. First, to understand open interest, you need to understand open interest in case of futures market. First, you need to understand open interest in case of shares, equity shares, how open interest is computed, you need to understand. See, assume that a company A Limited is going for IPO, okay, and assume that all of its shares, IPO, I told you, okay, assume that the shares can also be issued by a fresh issue, or it might be even promoters offloading their stake, அதாவது offer for sale also will be there. So assume that the entire 10 lakh shares, it is coming up with IPO and it is entirely of fresh issue. புரியுறது என்ன சொல்கிறேன்னு? The entire issue is fresh issue. Assume. Okay, now the company is issuing 10 lakh new shares. Now the open interest is created. Okay, the company by way of IPO, it is coming up with the IPO for these 10 lakh new shares are issued now. So the open interest is created. The open interest is created for these 10 lakh shares with respect to this 10 lakh shares. Are you listening? Which can be traded among investors. Now the point is, okay, in the secondary market, it will be getting listed a few days after the IPO. See, first what happens, initially they come up with the IPO. IPO, investors will apply for the IPO. Okay, through the demat also you can apply. Okay, and you apply for the IPO. And the allotment will happen based on the process. Bidding process will be there, allotment will be happening, and sometimes allotment, okay, you may be allotted the shares, you may not be allotted the shares, it all depends on the company. Are you understanding? Now, these shares after, okay, coming into the IPO, they will list these shares in the secondary market, say 3 or 5 days later. Are you understanding? Have you all seen the news articles, Money Control, and the Economic Times will be given? IPO, they will initially come up with IPO. The company will take the funds from you directly through IPO route, correct? Once IPO is done, they will list these shares in the BSE and NSE stock exchanges. They will list in the secondary market. Are you understanding? The secondary market, when shares are listed, thereafter the shares will be traded among the investors themselves. Are you understanding? There is no company will not get involved. Are you understanding? The secondary market, company, are you buying or selling to the company? No, investors will buy among themselves, trade among themselves. Are you understanding? So in that case, secondary market will never create any open interest for the equity shares. Shares open interest will be created only through IPO. Are you listening? Or new issues, buyback is there. Okay, company only can influence the open interest for the equity shares. Are you listening? This is the conclusion. Very simple. See here. A Limited goes for IPO, 10 lakh shares were issued for a fresh issue, then it gets listed in the stock exchange. Now, open interest for the new shares of 10 lakhs is created through the IPO process. In the secondary market, investors will be buying and selling these 10 lakh shares only. The ownership of shares are changing hands, but the open interest remains the same, which means for the company, open interest will be influenced. Okay, for equity shares, open interest will influenced by way of, new issue, okay, new issue of these shares or buyback of the existing shares. Are you listening? Okay, in other words, share market only the company can influence OI. Only the company can influence OI in case of shares. Equity shares, the underlying asset, OI can be influenced by the company only. The company's decision by way of buyback or by way of fresh issue, the OI will be influenced. Come to the futures market. Contrary to the contrary, if you come to the futures market, you see that futures contracts are created by whom? The instruments are created by whom? Investors themselves. They are created by investors themselves. Company is not creating, just like creating shares. Company is not creating these contracts. Investors will themselves create these contracts. Are you listening? Okay. See, futures contract are not created by the company but by the investors. When a futures contract is entered into between two parties, the contract can be classified into 3 ways or 3 types I can classify. Okay, see, both parties creating new position. There might be a situation, 3 situations I should say, 3 types, 3 situations I should say. See, for example, both parties are creating new position, which means I am buying, okay, I am taking a long position in futures, correct? I give a buy order in futures, which means I am willing to buy, okay, March TCS futures I am willing to buy today on 13/3, correct? I give a buy order. Now, there is some other party who is willing counter sell, who is willing to take sell position or short position, correct? I told you the between the exchanges will match the position. If you want to sell, okay, and one party want to buy and another party want to sell, the matching will happen. Are you understanding? So in that case, see here, this is inge BSE NSE irukpa. This is the exchange. This party A, okay, A is buying, B na buying pa. Okay, there is X party X. He wants to sell this, take a short position in the futures. So there is a party who is long in futures, there is a party who is short in futures. Exchange will match their position. Are you all understanding? Transaction will take place. Now, both the party assume are new parties and the new contract is created. Are you understanding? Both parties creating new position. That one party is buy position, other party is sell position. Okay, see, In the contract, we tell in the contract, one party B, other party is selling, the contract will be executed only when the corresponding position is taken by another party. Yeah, are you understanding? If one party is taking buy position and no one is there opposite, the contract will not get executed. Are you understanding what I'm trying to say? Say, this is the point. See, OI will increase because new contract is created. When both the parties are creating new positions, A is also creating new position. Okay, X is also creating new position. Assume he is want to buy or sell any position, but he wants to create new position. Are you understanding? So this is open interest. This is open interest is getting created. For him, this is a new position. Buy sell na ore position. For him, that is a new position. He has opened a position. For A, he has opened a new position. For these contract, new contract is created. Correct? OI will increase where both parties are creating new positions. If one party is diluting existing position, another party is creating new position. For example, first this happened on first day. Second day, what happened? A took a buy position. Same A is coming up with sell position and closing the contract and running out of the contract. Are you understanding? In that case, okay, A is closing out his position. A has opened a position, A is closing out the position, one party is closing out the position. You tell me, the OI will get influenced or not influenced? Not at all influenced. Why? Because he is selling someone will enter into his position and will continue the contract. I also told you, are you listening? Okay, someone will enter into contract and continue the contract. Are you listening? It will not create new open interest. That is the point. Say, one party diluting existing position and another party creating new position. No change in OI as the contract is continued by the other person. Next, third option, both parties are exiting the position. So OI will decrease. Are you understanding? Both parties are exiting. Now come tomorrow, what happens? X sold. Okay, now what he is doing? Counter buy. Tomorrow he is coming out counter buy. A is also giving counter sell, assume. Okay, for his contract. So both the parties are exiting. OI will get reduced. Are you listening? Through example, we will understand it further. See, take question number 4 for discussion. What happens? They have given the transaction. Day 1, this is the transaction that is happening. Mr. A is long and with Mr. B short. Are you understanding? So A to the extent of 8 contracts. Day 1, there are two things. A is long and B is short position, corresponding short position, only in the corresponding position. So 8 contracts is created. Open interest to the extent of 8 contracts is created. One more transaction is there. X is long, Y is short, 6 more contracts. X is also new party, Y is also new party, new position taken by them. 6 new contracts are created, total 14 contracts are created. Day 1 contract understood the position in day 1. Currently, what is the position you understood? See here, calculate the open interest, we will see the day 1. A buy position, B sell position. This is open interest. This is open interest. Okay, plus or minus I have given. Minus it is getting reduced, plus it is getting added. See here, A and B is there. A is buying 8 contract is there, new position is created, no position, okay, nothing is diluted, and then B is also there, Y is also there. There is 6 more contracts, so 14 contracts balance is there in the day 1. Are you understanding? Plain simple. Next to come to the changes in open interest. Now you need to understand day 2 what happens, we will understand. A is taking a short position, Y is long position for 2 contracts out of the 8 contracts. Initially A took 8 contracts. Either 2 contracts, to the extent of 2 contracts, what is happening? You see, A is short position. A initially buy position, that is closing. A is short position, 2 contracts. A is closing his position to the extent of 2 contracts. Silently he is closing his position, 2 contracts he is cutting off. Are you understanding? His exposure he is cutting off. What is happening? A is cutting off his exposure. Come to Y. What is happening with Y? You need to understand. Y earlier took 6 contract short position. Now he is taking long position. He is cutting off. He is also correspondingly cutting off 2 contracts. Are you understanding? In the 2 contracts. Y is also party who entered in the day 1. Okay, A also entered into contract in the day on the day 1, and both are trying to exit their positions. 2 contracts will reduce. OI will reduce. A is selling, Y is buying. OI increased or not? Will not increase. But it is decreasing. Yes, 2 contracts will get decreased. Are you understanding? Come to the second transaction of the day 2. There is one more transaction. X is short with C long. Listening. 6 contracts. Appo next day what is happening? See my children, X is short. X is there, one party is closing out his position. X was long, X buy position. Now X is taking short position, is closing out his position, correct? Yes, he is running out. But you tell me some other party from day one is diluting his stake, or new party is coming in place, new party. The C is the new party, not at all, old party. Day one he has not taken any position, correct? New person is coming and taking his sell position as long position. Are you understanding? X is selling, that corresponding selling position, he is taking a long position and the matching happens. C is continuing the contract. Are you understanding what is happening? So there is any change in open interest? No change in open interest. No change in open interest to the, with respect of this 6 contract. Okay, with respect to this 6 contract. That is why I have given you here X is taking sell position, B is taking buy position, C is taking buy position. Since C is new person, he is just carrying forward the existing contract, and there is no change in open interest, no change in additional subtracting open interest, and the balance contract remains same at 12 contracts. Are you understanding? This is a concept called as open interest. Now shall we move on to the fair futures price? Okay, now we will discuss fair futures price or valuation of the futures. See, how to value equity and bonds we saw in the previous segment, correct? Here in this segment we will try to analyze how to value the futures. Okay, so futures, as we know, futures value will be derived from the underlying asset, correct? It will not have value on its own, but which will derive its value from the underlying asset. So what is the how to find the value of the futures? Very simple. Spot into e to the power. What do you mean by futures? Okay, spot price compounded to future, which means you take the spot price of the underlying asset, then you compound it continuously using risk-free rate into e to the power TR. There are two things to be told here. One is that derivative instruments always you use continuous compounding. Are you listening? So derivative instruments always we should use continuous compounding. Next point, we should always use risk-free rate. Why we are using risk-free rate for derivative instrument, we will see under options chapter. Okay, there under derivative valuation segment, I will tell you how to consider the thing. Okay, how to use the risk-free rate. Are you understanding? How to why to use the risk-free rate? Why to use the risk-free rate as for compounding and discounting? Even though the derivative instrument is risky, still why we need to use risk-free rate? Question arises. For that I will discuss later. Are you listening? So derivative instrument, two things will be there. One is that you should use risk-free rate. Even though some questions may give you cost of capital, it is nothing but risk-free rate. You should understand it as risk-free rate. Then continuous compounding you should use. Institute interchangeably they will give you simple interest also, simple normal compounding also they used to give. Okay, as per the questions requirement you should solve, but understand that continuous compounding only will be used practically. Are you listening? Sorry. Futures price of an asset is derived from the spot price of the asset. Futures price is nothing but spot price compounded to given future date. Now futures, if you see the futures maturity period will be there now. See, after 28 days the time to expiry suppose is 28 days or 40 days. You will consider the interest portion for that many days and then you compound it to future. Are you listening? Say, using the given risk-free interest rate. In derivative contract, only continuous compounding should be used, and hence fair futures price is equal to spot into e to the power TR. Now the point is, okay, how to compute e to the power TR I have discussed in time value of money. Please go through that. Are you listening? I am not again going to discuss how to do calculation of this continuous compounding. Listening? Say. Normally, having a futures contract asset is more advantageous than having an asset itself. This is related to commodity transactions. I'll tell you commodity futures. What happens where the underlying asset is commodity. Say you have rice, wheat or crude oil. There are so many commodities now. So, where you are valuing futures, commodity futures, there you will apply something called as cost to carry model. Even it applies for normal futures also. When you take financial assets, okay, there will be some financing cost. See, I'll tell you what happens. Okay, here I need some space to explain. I'll explain it here. Can you see this? See here. I have two options. I have two options. One is hold the asset, hold the underlying asset, hold the underlying asset, or okay, you have an option to hold the contract on the underlying. Are you understanding? So this contract is nothing but futures, options, all these are contract based on underlying asset. But this is F and O I am putting. Okay. Now here the asset itself, say shares, debentures or anything here. Okay. You have commodity na. Okay, crude oil, any underlying asset. This is the thing. So you have an option to hold either hold the underlying asset or you can hold the contract on the asset. Sometimes it is advantageous to hold the asset and sometimes it is advantageous to hold the contract on asset rather than holding physically the asset itself. For example, I'll tell you what happens. If you hold the contract on the asset and not the asset itself, okay, you will avoid some cost because holding the asset physically will have some cost on its own. For example, if you hold a financial asset, you will have some interest cost, correct? Financing cost will be involved. Are you listening? Or if you try to hold the commodity like wheat, rice, if you want to store these assets physically, you have to incur some storage cost, handling cost. All these costs are involved, correct? I can tell you financing cost, okay, storage cost, handling cost, correct? All these costs are involved when you are trying to hold physical assets, hold these assets itself rather than holding the contract. So when you hold the contract, naturally you will avoid these costs. There will be no financing cost, there will be no storage and handling cost, correct? You will avoid these costs. In that case, holding the contract on the underlying asset will be beneficial to you, correct? Appo futures price, fair futures price, contracts price is nothing but fair futures price is nothing but the spot price of the asset plus something called as cost to carry. Are you listening? Cost to carry, which means I don't incur these costs, I save these costs. Are you listening? That will be added. Simply put, fair futures price is spot price plus cost to carry. Cost to carry. Now when you say spot into e to the power tr, here this cost to carry, here the compounding part takes care of the cost, additional cost. Are you understanding? Where financing cost is involved, now e to the power tr, it will be adjusted. Are you listening what I am trying to say? Both are one and same only. Okay, contextually you need to understand. Question will mention which method to solve. If nothing is given, you can use this method as well as that method. Are you listening? Okay, e value given, you should assume that you should solve using this method. If e value is not given, simple interest only, then you will use just to cost to carry model. Spot price you will take plus simple interest you will apply, and this is nothing but cost, the compounded value you will get. Are you listening? Now I told you there is an advantage when you hold the contract based on the asset. The advantage is that you save the financing cost, storage cost or handling cost, correct? There is a cost also involved. If you suppose sometimes what happens, okay, you can hold the asset rather than holding the contract on the asset. What happens sometimes, holding the asset will give you some benefits. Like for example, it will give you, for example, if you are holding the shares, okay, instead of holding futures contract, if you are holding the shares itself, it will give you dividend, it will yield some dividend, correct? Dividend yield will be there. Listening, if you are holding suppose some crude oil or something, by refining the crude, okay, by selling it for a profit, you can earn some income on the crude oil, correct? What I am trying to say is that you will have some benefit from the asset also. In that case, if the benefit is higher, are you listening? That benefit you will not get by holding the contract. Yeah, are you listening? Only if you hold the asset, you will enjoy the benefit. Sometimes there might be a situation where the benefit arising of the asset will be even more than the cost involved in the asset. In that case, okay, the benefit is called as conveyance yield. This benefit arising from the holding of this asset is called as conveyance yield. When the conveyance yield is greater than the cost to carry, are you listening? When conveyance yield is greater than cost to carry, it is better to hold the asset itself rather than holding the contract. In that case, what will happen? Holding the asset will be cheaper than holding the futures contract. Are you listening? Generally speaking, okay, what will happen, I'll tell you. Okay, fair futures price is nothing but spot plus cost to carry minus conveyance yield. Generally, okay, I'll show you an example. Suppose spot price of the share is 1200. Are you listening? Spot price of the share is 1200. plus assume the cost to carry is, say, the interest portion of it is 100 rupees, and the conveyance yield is, say, 50 rupees. Are you understanding? The income arising out of the asset is 50 rupees, cost involved is 100. So this is, if you see this portion alone, CTC minus convey yield is which is higher? Cost to carry. Up this is net cost to carry. This is having net cost to carry. If you adjust this 100 minus 50, okay, up 1200 plus 50 is nothing but 1250. Are you listening? Fair futures price will be 1250. Either you have net cost to carry. This is called as net cost to carry. Where cost to carry is more than conveyance yield, it is called as net cost to carry. In that case, okay, the fair futures price will be more than spot price. Are you listening? Okay, I'll get back to the notes later on. I'll first explain to you, then I will make you understand through the notes. Are you listening? Everything given in the notes, don't worry. Now, where suppose, okay, spot is same 1200, but the cost to carry is also same 100, but sometimes conveyance yield might be even higher, I told you. So it is 200. Assume it is 200. In this case, what happens? The cost to carry and conveyance yield, if you net it off, it is net conveyance yield. What will happen? Okay, 1200, okay, minus 100 you should do, correct? 100 minus 200, it will become minus 200, minus 100, it will be 1100. In this case, fair futures price is 1100 and spot price of the asset is 1200. Are you understanding? Spot price is greater than the fair futures price. Spot price is greater than futures price because of the net conveyance yield. Since the conveyance yield is higher, this is the situation. Are you all understanding these two situations carefully? Okay, now you see, okay, I'll explain you through notes. Now you will understand why I wanted to discuss. We have two different markets, okay, that is backwardation and contango. Okay, to understand that I was explaining this. See here, 1 second. See, normally having a futures contract on asset is more advantageous than having an asset itself, because having an asset involves cost of holding it, like financing cost, storage cost and handling cost, etc. In case of commodities, etc. Okay, commodities also, in case of shares also it will be there. This is called as cost to carry. Thus lesser contract have more value than the underlying asset price to the extent of cost to carry when there is net cost to carry. Are you understanding? Assume when the conveyance yield is lesser than cost to carry, or there is no conveyance yield at all. In that case also net cost to carry will be there. If there is a cost to carry, okay, then what will happen? Futures contract, the contract based on asset will be of more value, will be more valuable. Contract on asset will be more valuable than the asset itself. So fair futures price is nothing but spot price plus C2C, cost to carry. We have a simple equation, spot price plus CTC, futures price. Sometimes there is a benefit in having an asset rather than futures contract on the asset, because the asset may give a yield. Okay, shares will give you dividend, currency will give you interest. Why currency are given? Don't ask him, because see, okay, based on currency only, currency futures are there, so the currency derivatives, that's why I'm explaining. Cattle gives milk, tree gives fruits, all these things are there, because commodity futures, when you are valuing, you will see based on the underlying asset, commodity, correct? There is a supply shock for the asset. When there is a supply shock for the asset will have more benefit. Holding the asset will have more benefit. When there is, when this will happen, I'll tell you, when there will be net conveyance yield, when there is a future expectation of the recession, when the market is expecting recession in the near future. For example, I'll tell you, okay, in the past 3 or 4 years, if you see, the inflation data in the US is, okay, coming stronger. It is getting higher and higher. In that case, what happens? If inflation is higher, okay, a recession might come because of higher inflation. Are you understanding? Monetary policy will be tightened. Because of that, okay, recession might come. In that case, when you are anticipating recession, what will happen during recession? Supply shock will be there. Are you listening? Demand will be there. To meet the demand, supply will not be enough. In that case, okay, there will be supply shock. Due to that, the prices of each and every asset will go up. Are you listening? Already inflation is there, so prices of the asset will shoot up. In that case, I would rather prefer to have physically the asset rather than the contract on the asset. You tell me, children. You will have, see, if you are in paint manufacturing, if you are into paint manufacturing, for example, there is a company called as Asian Paints, and the paint sector is there. It is heavily dependent on crude oil. Crude oil is naturally the raw material for this paint industry. What happens if the Middle East, if you see nowadays the Middle East war is happening, okay, they are all net exporters of oil. So when they are having economic trouble, the oil prices shoots up. if the crude prices shoots up, what happens for a net crude importing company like India? The import bill goes high now. So companies like these Asian Paints and all, or paint industry, the raw material is crude oil. Are you listening? So because of the raw material price hike, okay, the production will get affected. Are you listening? Margins will get affected. That's why, okay, companies might want to stock up with the crude oil, underlying asset, correct? So it feels that since it is anticipating, if the company is anticipating that the crude oil price is going to increase, it would rather have, okay, if the storage is available, rather have the crude oil rather than the contract on crude oil. Are you understanding? It is better to have physically the asset, because in the future there will be a supply shock. In that case, it will not be enough to meet our demand. So better to have the physical asset itself. In that case, what will happen? So where you are anticipating recession, in those cases, okay, and you are expecting a price rise, you will have the asset rather than the okay, because it will yield something. Okay, that's the point. This is the yield which the holder of an asset gets, but not the person having a contract on the asset, is referred to as conveyance yield. The benefit arising out of the holding the asset is called as conveyance yield. In this scenario, fair futures price is spot price plus C2C minus conveyance yield. This conveyance yield you will adjust. If the conveyance yield is lesser than cost to carry, of course, okay, the futures price will be greater than the spot price. What is the relevance of futures price and spot price? Why we are comparing now? Next stage I will discuss. Okay, can futures price be less than the spot price? Of course, yes. This happens when the conveyance yield is greater than the cost to carry. Just now I explained. Remember, two scenarios I given in the notes now. You see that. Okay, so conveyance yield when is greater than the cost to carry, net conveyance yield will be there. Hence, your futures price will be, okay, reduced even lesser than the spot price. Like the difference between the spot price and the futures price is called as basis. This is called as basis. Are you listening? Basis is nothing but spot price minus futures price. And the basis points you will read in the forex, 100 basis points is equal to 1%. That is basis points. Here, basis is nothing but spot price minus futures price. Are you understanding? In the basis, if it is negative, if the basis is negative, very simple, yeah, spot price 1200 and futures price is 1100. Are you listening? If this basis is positive, when the basis will be positive? When the spot price is higher than, this is spot price, this is futures price. S in a spot price, F in a futures price. Up when spot price is higher than the futures price, basis will be positive or negative? Positive, because spot price minus futures price. Yeah, are you understanding? Now, when the, okay, when futures price is more than, okay, assume futures price is 1300, spot price is same 1200. The basis is spot minus future, basis is equal to negative. Are you all understanding? Now the important point is, when the basis is negative, generally this will be the market scenario, basis will be negative. Generally if you see, futures price will be trading, okay, more than the spot price. Generally if you see the market quotation and all, every time, most of the time it will be quoting in the premium, quoting in premium. The futures price will be more than the spot price. Are you understanding? But sometimes, rarely, I told you, in adverse economic scenario, when the participants are expecting a recession in future, abnormally what happens? Spot price will be even higher than the futures price. This is when the basis will be positive. Spot price is higher than the futures price. This is called as okay, backwardation market. The first one, when the basis is negative, the market is called as contango market. Are you understanding? Futures market is said to be in a contango, you see here, where there is net cost to carry. When there will be net cost to carry, when the basis is negative, there will be net cost to carry, and the future market is said to be contango. Are you understanding? Contango futures can go into backwardation when information about conveyance yield is received. See, sir, can I, will the market jump into backwardation from contango? Yes, possible. See, you are in the contango market. Normally, contango market is going on. But information, we are receiving job data, inflation data, macroeconomic data related to US. This quarter we are receiving these data, correct? And market participants are feeling that US there is going to be a recession. Are you understanding? Because of expected recession, what will happen? The market will move on to backwardation. This is possible when the conveyance yield, the information related to conveyance yield is, okay, in the market. Okay, next, basis when it is positive. When the basis is positive, what happens? There will be net conveyance yield, then only basis will be positive. Yeah, the conveyance yield is more than cost to carry, and what happens consequently? Okay, the spot minus conveyance yield na, appo the futures price will be even lesser than the spot price. In that case, the futures market is said to be in backwardation. Okay, backwardation market can move to contango. Yes, of course it is possible. When it will move na, when the conveyance yield ceases to exist, when the conveyance yield related information or the conveyance yield finishes, and from recession, when the market is recovering, slowly it will move on to again contango. Are you listening? Say the basis narrows as the futures contract near its maturity. Let it be contango market or backwardation market. Let it be net cost to carry or net conveyance yield. There will be always the gap na. See, very simple. Sometimes futures price will be more than spot price. Sometimes spot price will be more than futures price. But this is the situation as of today. What happens? When you are nearing the maturity period, today, assume in our example, we learned that 13/3, on 13th March, we are entering into futures contract. Today, we are going to the market and trying to buy the futures contract, and the maturity is 26th March, correct? The maturity date is 26th March. Are you listening? In that case, if the maturity period is 26th March, what is happening? On the date of maturity, both the futures price and spot price will converge, will be one and same. This is called as concept of convergence. Because see, futures na, today you are agreeing upon the price on the for the future date. On that date, what will be the price na? Same as spot price. Yeah, you're listening. Most of the time it will be converging. But sometimes questions, I have seen questions where they will give you different futures price and different spot price. Are you listening? On 26th March, this is the futures price, they would have given the question, and this is the spot price. On 26th March, this is the spot price they would have given. In that case, which price you will consider to net off the P&L, to calculate the P&L from the futures contract? Now you will consider only futures contract. Are you understanding? Generally, nothing given in the question. Now you will assume that the future cash market prices, spot price and the futures price will converge and will be one and same. But in case where questions mentions two different prices, then you will consider futures price only. That only you bought or sold initially, that only you will consider to close the position. Are you understanding? This is what I wanted to discuss. Now I will discuss the diagram. Please see here. 1 second. Please see here, basis is negative, basis is positive. When basis is negative, see here, the x-axis, y-axis given. The y-axis, you have futures price. X-axis, you have time to maturity. If you see, let's assume this is 13/3. This is the point at which we are buying the futures contract. Futures price is more than spot price. This is the futures price. Are you listening? This is the price. Generally, in the left-hand side, the price is given. Spot price is there. Anyway, this is futures price. Futures price, if you see, the futures price is higher. In this case, futures price, this is quoted futures price in the market. Are you listening? This is quoted futures price. Futures price is more than spot. This is basis is negative. When the futures price is more than spot price, the basis will be negative. Are you understanding? Net cost to carry will be there. Are you understanding? So net cost to carry will be there. Basis will be negative. Spot minus futures price will be negative. In this case, what happens? Market is sent to be a contango market. Correct? When basis is positive, what happens? Spot price is higher than futures price. Are you listening? Spot price is higher than futures price. The market is said to be backwardation. Market is said to be in backwardation. Now you see, in both the cases, this is the time to maturity, x-axis. When the contract time comes near the maturity period, 3 months contract or 2 months contract, whenever is a maturity period, here convergence happen. On the day of maturity, the futures price and spot price will converge and will be one and the same. Are you understanding? This is what I wanted to clarify. Here I have given the summary. Futures price calculation, I told you e to the power TR. Here one thing is that dividend, shares dividend is there. This is conveyance yield. Correct? Now sometimes dividend might be given in amount terms or in yield terms. Dividend yield, I told you, dividend yield is nothing but dividend per share divided by market price per share. Are you understanding? Or total dividend divided by market capitalization. Are you listening? Say, so this when they give in yield how to compute, or normally when they give how to compute continuous compounding, sometimes in the question we can use simple interest also. I told you na, various scenarios I will discuss here how to compute. Now I am clarifying. See here, stock or index futures is given, no dividend is given, CCRRI na continuous compounding risk free rate of interest. CCRRI sometimes they mention in the question. Sometimes they will give E value directly and they will tell nothing about continuous compounding. In that case also you will use continuous compounding. E value given na, then you should use. Otherwise sometimes they will give CCRRI. What do you mean by that? Continuous compounding risk free rate of interest. That is what would be given. If nothing is given, if both of these is given, either of these is not given, in that case what you should do? Okay, you will do normal simple interest, you will just add cost to carry method, you will follow. Are you understanding? See here, nothing given, dividend, no dividend is given, and continuous compounding should be used now, spot into e to the power TR. Are you listening? This is the basic thing. Now, if stock futures or index futures we need to compute, either no dividend and simple interest. No dividend is given, simple interest we need to compute. What is that? Very simple. Yeah, spot price 1 plus r raised to the power n. Normal compounding, you know, like that you will do. Or to put it simply even further, okay, to simplify, you can just use spot plus interest. This interest, okay, simple interest you compute. Simple interest how to compute? Now, spot into r percentage, whatever rate is given, into number of days to maturity. You will count the number of days to maturity. Are you listening? If month given na 1 by 12 or 2 by 12, you can use directly 1 month, 2 month given in the question na, or days given na, you take in the middle of the month they have given na, till the maturity you count the days and number of days divided by 365. Simple interest you add to the spot, you will get, okay, futures, fair futures price. Next to come to stock futures or dividend given as annualized yield, and this is continuous compounding. This is very important. See here, dividend given as annual yield and continuous compounding you should use. Now what you should do, fair futures price is spot into e to the power TR. I told you in the time value of money itself, TR, T is time to maturity, in this case time to maturity. Okay, this is annualized time to maturity you should use. For example, if the futures contract is for 3 months, upper T you should use 3 by 12. Are you listening? 3 by 12. R na, and rate of interest you will use, annualized rate of interest you will use, correct? Inge, okay, where risk free rate of interest, of course risk free rate of interest will be given in the question. Now the R is there na, here you will adjust the dividend yield directly. Are you listening what I am trying to say? Very simple, yeah. The risk free rate of interest is 10%. Assume here I will write the risk free rate of interest is 10%. RF is 10%. Listening, dividend yield is 3%. Okay, in this case, and T is, assume 1 month, T is 1 month. I am writing here 1 month. Now how should you form the equation? Very simple. Spot into e to the power T, of course 1 month na 1 by 12, simplified version 1 by 12 I am taking, into R minus D you should use. R is 10% na 0.10 minus 3%, 0.03. Are you understanding? 0.1 minus 0.03, 0.07 na? Okay. 0.07 into 1 by 12. 0.07 divided by 12. How much is that? 0.00583, which means e to the power 0.00583. You see the question, if they have given directly e to the power value 0.00583 na, straight away take from that. If nothing is given, of course you know how to compute using calculator. Use the calculator and find it out. I told you now how to use it. Okay, you don't need to go to the third factorial, just use 1. The number plus, what you should do, 1 plus, okay, the number 0.00583 divided by 1 factorial plus 0.00583 square divided by 2 factorial. You will get the E value. Are you understanding? Say, assuming you already know that. I am not discussing here. Say, this you understood? Next to see, stock futures when dividend is given as annualized yield, but simple interest you need to compute. In this case, what you should do now? Okay, very simple. Yeah, annualized yield is given. You will compute. Okay, this formula you forget about this. Okay, this might confuse you. That's why I am telling. What you should do? Annualized yield given na. Simply apply the yield. If the market price is given, spot price would be given. Simply apply the yield and find out the dividend in amount terms. Are you understanding? You can get the dividend in amount terms, correct? Simply what you should do, okay, get the dividend in, convert the dividend in amount terms, then spot price plus CTC, then minus dividend. That's all you need to do. Simple interest we have, correct? That C to C you find simple interest. Now spot into R into N by 365, already you know how to compute it. That you add cost to carry, financing cost you add, minus dividend, you convert from the annualized yield, you convert into amount terms. Are you understanding? All this example we have, one question I have put, okay, there we can solve. Are you listening? There you will understand absolutely. There will be no doubt. See here, spot plus C to C minus dividend. This is what you should do. Next, okay, dividend amount given, CCRI, continuous compounding you should use. What you should do? Very simple. Spot price minus present value of dividend into e to the power TR. In the present value of dividend, you should also use present value of dividend. You should discount the dividend. When you are discounting dividend, there also you should use continuous compounding. I'll just show you. See here. In case when dividend is given, and continuous compounding should be used. Okay, when dividend is given, dividend amount is given, okay, CCRRI you should use. In that case, what you should do? Simple. Okay. Now, where is that? 1 second here. Okay, see. Dividend amount is given, CCRIs. See, in this case, what you should do? Spot is there, correct? Now the dividend, now see, assume the futures is for 3 months. The futures maturity period 3 months is there. But dividend is paid, okay, is paid after 1 month. The share is giving dividend after 1 month, not after 3 months. In this case, what you should do? Spot minus present value of dividend you should do and convert into revised spot, which means, okay, ex dividend price. Are you listening what I am trying to say? You convert the spot price into ex dividend price first. Then you should use e to the power TR. Then compound it to future. The catch is, present value of dividend first you need to do. So how should you do? Whenever this is continuous compounding you should use. The present value of dividend also you should continuously discount. Which means, continuous compounding and discounting also I told you, spot minus present value of dividend. What you should do? Dividend divided by e to the power TR will give you discounting. See, any number multiplied by e to the power TR will give you compounding, or any number divided by e to the power TR will give you discounting, or any number multiplied by e to the power minus TR. Are you all understanding? This is C. Dividend by e to the power TR is as good as dividend into e to the power minus TR. Will be same answer. Are you listening? Say. Now you see, dividend divided by simplicity, you only need to compute minus TR, you don't need to confuse e to the power TR. Here you will divide, that's all. Listening, for discounting you will divide, for compounding you will multiply. Listening, so now there is a catch. The dividend divided by e to the power TR is there. Here you see, you will get a value, then again you will compound it e to the power TR and you will get the fair futures price. Here, while discounting this dividend, you should consider the time period for dividend, which means dividend is paid after 1 month. 1 month dividend you want to discount. Are you listening? Futures maturity period might be something different. Dividends maturity, the dividend, the date, due date for the dividend from now will be something different. Are you understanding what I am trying to say? So that you should consider for discounting dividend. But for computing fair futures price, again you need to compound. For that you will consider the time, the TR, time you will consider as futures maturity period. Always remember. So dividend e to the power TR, here you will consider 1 by 12. 1 month 1 by 12 you will consider into 10%. Okay, 0.1. 1 by 12 into 0.1 you will consider and discount the dividend. But here assume this is 3 months. If futures period is, maturity period is 3 months. What you will do? Okay, e to the power TR you will consider 3 months. 3 by 12 into 0.1 you will consider and compound. Which means for discounting you will consider dividend discounting. The due date for dividend will be considered, and for computing fair futures price, the futures maturity period is relevant. Are you listening? This is what I have given here. See here. dividend amount given, yes, here stock futures or index futures, dividend amount given, continuous compounding. Now, spot price minus PV of dividend, while discounting, amount will be given. Numerator dividend amount is given, that is fine. But for discounting, you should use continuous compounding again. That e to the power TR, you will divide and find it out. Again, while multiplying, which means for compounding, the maturity period alone is important. Dividend period and futures maturity period is different. For computing fair futures price, you will compound using futures maturity period. Say, next is stock futures or index futures where dividend amount is given and simple interest is to be considered. What you will do, fair futures price is equal to spot price minus present value of dividend into 1 plus r raised to the power n. Are you understanding? In this case, what you should do, dividend amount is given, but simple interest, forget about everything. Present value of dividend also, simple, discounting you do, you don't need to do continuous compounding, discounting. Simple discounting you do, present value of dividend you will find out. How to find simple interest and present value by discount? Are you listening? You will find it out, and then 1 plus r raised to the power n you will, or cost to carry model. First you will bring it back, bring the dividend to present value terms, remove it from the spot price, then you will just add the interest portion. Are you understand? Commodity futures are same as stock futures, except that we should include the storage cost to carry, and dividend will be replaced by conveyance yield. Conveyance yield will be, dividend will be replaced. In case of stock, they will give the dividend value. In case of commodity, conveyance yield will be given, or some other income will be given. The point is, income arising of the asset is known as conveyance yield. Shares will give you dividend. Other assets will give you other income. Are you listening? Say, fair futures price. I have given few questions. Quickly we can go through these questions. See here, fair futures price. Consider 3-month maturity forward contract on a non-dividend paying stock. Interchangeably, see, even though they use forward contract, interchangeably forward futures might be used. But using the data, you should understand. See, in a forward contract they have used it, but again they have asked what is the price of the future contract. You should understand that future only they want to tell it as forward, because really speaking, the forward contract instrument is there. That is different. This OTC contract, there are some differences between forward and future. Generally, see, you should understand that in the forex we will learn that. For forward contract, it is OTC contract, over the counter contract. This is future contract, is exchange traded. It will be traded in the stock exchange. Sorry, the differences and all I don't want to discuss now. Understand that sometimes interchangeably they will use, but of course futures will be referred. Here future contract they are specifically mentioning, so you should consider future only. So consider 3 months of non-dividend paying stock. Correct? Up a spot into e to the power tr, the stock is available for 200, that is the spot price, into e to the power tr. See, you know how to compute, but how to actually form this equation? E to the power tr, here you tell me what is the time. 3 months, up a 3 by 12, e raised to 3 by 12, see, e raised to 3 by 12 into r, what is the rate? 10%, up a 3 by 12 into 0.1, what is that? See, 3 by 12, 0.25, or you can straight away do that, 0.1 into 3 divided by 12, how much is that? 0.025, are you understanding? Up a e to the power 0.025. Once I'll explain how to e to the power, once again just revising, what is the value of e to the power 0.025, how to compute it? Very simple. If you have the calculator, what you should do, first you press 0.025, correct? 0.025 into is equal to, which means we are squaring it up, 0.025 the whole square into is equal to, divided by 2 is equal to how much? 0.0003125. That you put in memory plus. Again, then 1.025. Correct? 0.025 yes. Memory plus memory recall. 1.02531. Some number here. Into 200. How much is that? 205.06. Are you all getting this number? What we did now, I told you shortcut. 1.025 square you did. Into is equal to, you will square it. Then this is divided by 2 factorial is 2. Correct? Plus anything divided by 1 factorial is nothing, same number. Up a 0.025. 1 plus 0.025, I added 1.025. This already put in memory plus 1.025 will give you 1.02531 some number into 200 spot, you will get the futures price. Are you understanding? Next, fair futures price. See, the price of ACC stock on 31st December was 220 and the futures price on the same stock on the same date, i.e. 31st December 2001 for March 22 was 230. Now tell me, friends, here, see here, the price of ACC stock, what is this? This is the price quoted, the spot market or cash segment. Are you understanding? Cash market, this is the price quoted. Are you understanding the difference? This is the futures price. On the same date, This is price quoted in the cash market, this is price quoted in the futures market. They need not be same. Are you understanding? Say, time to expiry is 3 months, 0.25 year. Borrowing rate, of course, 15% per annum. Okay, and annual dividend on the stock is 25%. See, this is a risk-free rate. The borrowing rate, they might give you the interest rate. Risk-free rate should be ideally risk-free rate. Sorry, annual dividend on the stock is 25% payable before 31st 3 2022. Face value of the stock is 10 rupees. Is the future fairly valued, or the yes, is the future fairly valued? See here, what happened? We will need to find fair futures price. Appo very simple. Spot into e to the power t r. Correct? Appo they have used cost to carry model. Can you observe here? E value is not given in the question. Did they mention anything about E value? Nothing mentioned. Are you understanding? E value not given. What you should take? E value not given. What you should consider? Simple interest, normal simple interest you will use. Spot plus C to C. In the C to C, how will you compute? Spot into rate of interest. Okay, interest percentage into number of days divided by 365. Okay, here you see they have taken spot price 220 plus this is spot plus C to C. This is 220 plus C to C. What they have done? 220 plus 15%, 0.15 into 0.25. Are you understanding? Now dividend is given, but dividend 25 payable, 25% payable. Now 25 you will apply on what? 25%, simple percentage terms. I told you 3 types of dividend rate. Here simply dividend rate which we will apply in the face value. Face value given, yes, face value given 10 rupees. Up 2.5 is the dividend. 2 rupees, 2.5 is dividend. Up 2.5. Ideally, what you should do, you should discount this 2.5. Are you understanding what I am trying to say? Before 31/3/2022, okay, not on 31/3/22, but still. Now, what you should do, you should discount this dividend and revise the spot. But what they have done, simply they have considered this dividend. Okay, what they have done, I will tell you. Spot plus C to C minus dividend they have done. Are you understanding? Okay, here because what they have done, are you listening what I am trying to say? See, here they have considered spot 220, then C to C 220 into 15% into 3/12, which means December 31st, March 2002, which means December, January, February, March, 3 months futures. 0.25 they have considered. Are you listening? 4 months or 3 months futures. March 31st December, correct? Yes, March, April, January, February, March. So 3 months future, 0.25. 3/12 minus 0.25. Again, this 0.25 is what? Dividend. 25%. Okay, this 25% which should be applied in face value. 2.5. This is given, so they have taken spot plus C to C minus dividend. Simply they have reduced the dividend. Ideally, they should do discounting percent value of dividend. They should do, but since okay, there is no E value given, they are doing straight away. Are you understanding? They have done this. Okay, ideally they should discount, but they have done this in the question on the in the Mari Pondabad. Like this, if they ask this question, you should do like this. Are you understanding? Sorry. Thus, as per the cost to carry criteria, the futures price is this much, which is less than the actual. In the summary segment, did I give you this? Okay, see here. Once again, yes. See here. Dividend as annualized yield. Simple interest, I have given you annualized yield. This one I give you. They used this one. Are you understanding? Ideally, okay. Normal dividend amount is given. They have done this, but. Okay, anyway, no problem. Okay, they should have done this. Present value of dividend they should have considered. No issues. Okay, say. Okay, next question. Question number 6. Please see question number 6. Consider a 4-month forward contract on 500 shares with each shares priced at 75. Dividend at 2.5 per share is expected to accrue on the shares in a period of 3 months. The compounded continuous risk-free rate is 10% per annum. Now clearly they have given E value, correct? See here, note E minus 0.25 is given, E to the power 0.033 is given. Now clearly you can understand that this is for given for dividend to discount to bring it to present value terms. This is for compounding the revised spot. Are you understanding? To compute fair futures price. In case there is cash income accruing to the security like dividends, the value of the forward contract is as follows. Okay, first dividend proceeds we will find. See here, how many shares are there? 500 shares. 500 into 2.5 is the total dividend, correct? But dividend, total 1,250, not 1.250, make the correction, 1,250. Now 1,250 into e to the power tr, into e to the power minus tr or divided by e to the power tr. 1,250 divided by e to the power TR na 3 by 12 into 0.1, which means 0.025 will give you the same answer, 1219.13. This is the present value of dividend. They have what they have done in this first step na, they have computed the total dividend, then they have discounted this dividend and brought it to present value terms. Now what you should do, the value of the forward contract, how you should consider, how you should do 500 into 75, correct? 500 shares are there and 75 contracts are. Share price is 75, correct? Share price is 75. 500 shares is there for each contract, correct? 500 is the contract lot size, then into 75 share price minus the present value of dividend. This is the total value, correct? Total futures value minus present value of dividend you will do. The present value of dividend you will consider, then you are compounding. Listening, then you compound it e to the power TR. While compounding, you notice they have taken 4 by 12. 4 by 12. Now 4 months maturity period is there. Na? Are you listening? 4 months futures maturity period is given, which means they have discounted after 3 months. They are, see here, shares in a period of 3 months. Now after 3 months they are going to receive the dividend. While discounting dividend, they have done 3 months discounting. And after discounting and reducing the dividend from the spot, what they have done, while compounding the spot price, okay, spot value, they have considered 4 month value. Are you understanding? 4 months compounding they have done. So yeah, 36,280.87 into e to the power 0.033 value is given straight away. You will get the solution. One question we will solve regarding commodity futures also. See here. The following information is available about standard gold. Gold is given, spot price 15,600 per 10 grams. Futures price 1,700 for 1 year futures contract. Now you tell me the market is in contango or backwardation. Spot price is 15,600, futures price 1,700. Futures price is more than spot price. Why it is relevant? Next question we are going to see. Are you listening? So market is in contango. Next, risk-free interest rate is 8% per annum. Present value of storage cost is 900 per year. From the above, you are requested to calculate the PV of conveyance yield of standard gold. Okay, see here. Now they have asked us to compute conveyance yield. Okay, see here what happens. This is the price, 15,600 is the spot price plus C to C is 900. Are you listening? C to C is present value of storage cost is 900. Listening? Upper C to C you simply add, correct? Minus conveyance yield, very simple. Fair futures price is equal to spot plus C to C minus conveyance yield. What the question is asking us to do, na? See, we have spot price given in the question, yes. C to C also directly given in the question, yes. And data related to fair futures price they have given in the question, we need to compute fair futures price. And as a balancing number, we will get conveyance yield, which means if the quoted price is something, from there implied conveyance yield they are asking us to compute. Are you understanding? Say, here, see, fair futures price is what we need to find out, correct? How will you find out? See here. This is what fair futures price is. How much is there? See, 1.085, 8.5% per annum. Risk-free interest rate is what? See here. 1,700. Futures price is 1,700, correct? Now, risk-free rate of interest 8.5%. There is correction in the question, I think. 8.5%. We'll check it out. Okay, if there is any correction, we'll make it. 17,100. Okay. Divided by 1.085. How much is that? 15,760. Okay. So, okay. So, the question has error. 8% per annum is wrong. 8.5% per annum. Are you listening what I am trying to say? Okay, the question is wrong. 8.5% per annum. Say. Now, the risk-free interest rate is 8.5% per annum. So, fair futures price is nothing but spot compounded to futures price. If a futures price, they have given us 1,700. Correct? 1,700 is the futures price. And risk-free rate of interest is 8.5% per annum. Correct? In this case, we need to find out discounted price 1,700 divided by 8.5 na 1.085. If we discount at 8.5%, how much we will get? We will get 15,760. Are you understanding? This is the discounted price. What we will do? We will reduce this value. listening what I am trying to say? This is 15,760. Upper spot plus CTC, how much is that? 15,600 plus 900. This is 16,500. Okay, and fair futures price is 15,760 minus 15,760. How much is that? 740. Upper 740 is the implied conveyance yield or present value of the conveyance yield. Are you understanding? They have given data to compute fair futures price. They have given spot price. They have given CTC, and they have asked us to compute conveyance yield as a residual number. Are you understanding? This is how it is solved. Note, conveyance yield means the benefit of physical. Okay, all this I discussed. It is better to hold the goods now, incur storage cost rather than buying in the future during the shortage period. Okay, next question number 8. Index futures with dividend yield. How should we compute fair futures price when dividend yield is given? Now, in the problem, index will have dividend yield also. I told you how to compute index dividend yield will be the average dividend yield will be considered. Regular lecture I used to discuss. Here I don't want to confuse you. Very simple. Nifty 50, there are 50 stocks. Okay, if TCS, if dividend yield is given, I can understand. It is yield of this share. How to compute the yield of the index? Are you listening? Then the weighted average yield will be computed. The composition of the individual shares in index will be considered. Weighted average yield will be considered. It will be published. The data will be published in the NSE website. Are you understanding? These things will be there. They have given monthly, where the monthly data of the yield of the index is given. There you need to consider average yield. Are you listening? Average yield for what period? For the period which is to be considered, for the futures maturity period. For example, if your futures, so if you are sitting in 1st January and you are trying to value a 3 months futures, you are trying to value a 3 months future. Up January yield, February yield and March yield you will consider. Simple average of these 3 yield you will take and find out the yield for the futures maturity period. Are you understanding what I am trying to say? Futures maturity period. Okay? What is the yield you will compute? Simple average yield you will take where the data is given like this. In the question they have asked, if they ask this question, you should do like this. For example, see here, 31st August 2011, the value of the stock index is 2200. The risk-free rate of return is given. The dividend yield structure is given. January, this is the dividend yield, this is the dividend yield. All these are dividend yield, but for varying months. Here if you see, okay, assuming the interest is continuous compounding daily, find out the futures price of contract deliverable 31st December 2011. You see first, what is the time to maturity? 31st 8, upon 9, 10, 11, 12. 4 months futures. This is 4 months futures. Are you all understanding? So this is 4 months future. Now, 4 months futures, okay, month also you should match. August was there, September, October, November, December, correct? Upper September yield will be considered, October yield, November yield, December yield. Upper 3, 3, 4, 3. 3 plus 3 plus 4 plus 3 divided by 4. Simple average you will do and get the yield as 3.25%. Are you listening? Once you get the yield, okay, spot into e to the power TR you should use, and the yield wherever they are asking continuous compounding with the yield I told you you should adjust this yield from R. Upper TR R minus D dividend yield you will consider, and then you will find out. To put it simply, spot into e to the power TR E is e to the power T time is 4 months 4 by 12. Rate is, how much is the risk-free interest rate? What is the risk-free interest rate? 8% in this question, 8% per annum. Into 8% 0.08 minus dividend yield which you found out 3.25 0.0325, correct? 0.08 minus 0.0325. How much is that? 0.0475. 0.0475. 4 by 12 into 0.0475 is how much? Okay, into 4 divided by 12, you get 0.01583. E to the power 0.01583. Are you all getting this? The number that they have given in the question itself. If you notice carefully, the number is straight away given. Are you all understanding? But once you should reach this step in order to solve that. Are you listening? Said this number you will consider and simply multiply with 2200. You will get the value. Are you listening? Said this is how you should do. Next question, contango and backwardation. Okay, why I discussed contango and backwardation? Now you will understand the relevance. Devesh sold 5 4 months Nifty futures on 1st February 2003 for 9 lakhs. At time of closing of trading on the last Thursday of May 2023 expiry, are you understanding? This also I told na, closing last Thursday, closing will be there. Okay, Nifty future turned out to be 2100. The contract multiplier is 75. Lot size of the future is 75. Based on the information about the price of one future contract, you need to find out 1st February. Appo 4 months future contract. Okay, it is there at the closing of the, yes, Nifty futures turned out to be 2100. Okay, contract multiplier is 75. The price of the future contract, see, very simple, price of the future contract we don't know na, so we will consider it as X. The reverse working, they don't know, they are asking at what price you have sold. You see, okay, 9 lakh if sold 4 months futures contract, correct? 4 months Nifty futures he sold, but the value was 9 lakhs, correct? Value was 9 lakhs and the contract multiplier is 75. Are you listening what I am trying to say? 9 lakhs divided by X will be the futures price, agreed? So one futures contract is how much? 1,80,000. Simple pa. Listening what I am trying to say? 9 lakhs. Okay, see here. Okay, 9 lakhs is there. Sold 5, see here, they were sold 5 4 months contract. Up 9 lakh divided by 5 you should do. Up 9 lakh divided by 5, okay, it is one contract, future contract. The price of one future contract is how much? 1,80,000. The price of one future contract, not price of share, price of one future contract. Either contract multiplier is 75, yeah. Up see, next question, they are asking Nifty index 1st February, if the futures value on the same date was theoretically correct. On the same day, risk-free rate of interest and dividend yield was 9% and 6%. Yield is given and index, the rate of interest is given. Okay, carry out calculation on a month basis. Okay, up a fair futures price, normally what you should do, see here, current futures price is 2,400. Are you listening? First you will find current futures price. Why 75 is given as lot size? 1,80,000 divided by 75 you will get as 2,400. Then let Y be the current Nifty index. Correct? Nifty index. Okay. Futures price of the index. Correction is there. Okay. Let Y be the current Nifty index. Accordingly, Y plus, okay, Y into this number, which means RF minus dividend yield. Simple interest they have computed, no issues, into 4 by 12 is 2,400, which means Y now how much is that? This is spot price. They are asking, okay, Nifty spot index value na in this question, if you notice, Nifty index they want to ask, this is spot. They are asking us to compute spot price. Okay, spot Nifty points they want to compute. If the futures value on the same date is theoretically correct, which means the futures price is theoretically correct. Now what does it mean? See, the actual futures price trading in the market and the fair futures price is one and same. Apo, we already know that, see, FFP is equal to spot into FFP is equal to spot plus C to C minus conveyance yield. Correct? Are you listening? FFP is same as actual futures price. They have given in the question. Correct? Actual futures price, we just found out one price of the futures contract, we just found out as 1 lakh by 80,000, 2,400. Correct? Up a futures price we have, and we need to compute spot price using the futures price. Reverse working. That is why this is very important question. Okay, reverse working is involved. Apo, okay, spot price. How to compute that? Very simple part. 2,400 is equal to spot. This is Y in a spot part. Spot plus spot into. Okay, this is risk-free rate minus RF minus dividend yield. Okay, dividend yield into 4 by 12. If you compound this, you will get, okay, how much is that? 2,376. This is the spot price. Are you listening? If you equate it to 2,400, you will get 2,376. Next, yes, this is the index value, spot value. What is the next part? The maximum contango and backwardation. The maximum contango and backwardation, the payoff of the transaction. Next two questions. See here. To determine whether the market is in contango or backwardation, first we shall compute basis. Base is nothing but spot minus futures price. Spot price is 2,376, futures is 2,400. Agreed? Apo, spot is 2,376, futures price is 2,400, base is negative, hence the market is in contango market. Maximum contango is 2,400 minus 2,000, 376.24. Very simple and straightforward. Next, payoff on the future payoff on the future transaction shall be 2400 minus 2100 into 75 into 5. Correct? 75 contract is there, 5 contracts, 75 lot size into the profit. 2400 minus 2100. Why 2100? Very simple. Yeah, India, you see 2100 is the expiry date futures price. Are you understanding? Nothing mentioned. We will assume that it is same as spot price, but 2100 is the closing nifty futures they have given. So use that data and compute the profit and loss. In that case, what will happen? 2400 minus 2100. Correct? The profit is 1,12,500. The future seller gains if the spot price is less than future contract price, as position shall be reversed at same spot price. Therefore, Mr. Gained 1,12,500 on the short position, which means he has shorted the futures at 2,400, sold the futures at 2,400, closing the position by counter buy futures at 2,100. 300 per future is profit. Okay, 75 is the lot size and 5 contracts he has traded. Upper total profit is 1,12,500. Are you understanding? Shall we move on to the arbitrage? See here. How will you compute arbitrage? Arbitrage in futures. See here. We have seen that fair futures price is nothing but spot into e to the power TR or simple interest or compound interest, no issues. And where the actual futures price is more or less, there will be arbitrage. Very simple. When the fair futures price and actual futures price are not one and the same, which means fair futures price are also called as theoretical futures price, which should have been the price of the future quoted in the market, but is actually quoting in the market at some other price. Are you understanding? The quoted price is some other price, but actually it should have been fairly quoted at this price, fair futures price. So if there exists any difference, we should assume that there will be arbitrage opportunity. So first tell me, when there will be arbitrage opportunity? When the futures price, fair futures price is not same as quoted futures price. It's not same as quoted futures price. See, futures contract. When the actual futures price is less than fair futures price, futures is undervalued. Are you listening? What should be the strategy? Okay, I understood that. Okay, arbitrage will exist when the actual futures price quoted in the market and the fair futures price is not one and the same. But how to take advantage of this arbitrage? Correct? How to gain using this arbitrage? The strategy is to buy the undervalued futures and sell the undervalued asset, overvalued asset. Very simple. Yeah, this is the same strategy which you apply for equity also. Correct? You buy the shares when it is undervalued, you will sell the shares when it is overvalued. Something if it is undervalued, you will buy, and something if it is overvalued, you will sell. Correct? When actual futures price, which is quoted futures price, is less than the fair futures price, what you will do? Actual futures price quoted in the market is undervalued. It should have been 100 rupees. Assume it is quoted at 80 rupees. What you will do? Are you listening? Actual futures price is less. It is undervalued. You will buy. Something undervalued, you will buy. You will buy futures. Futures, when actual futures price is less than fair futures price, futures contract is underpriced, you will buy the futures and short sell the underlying asset. Very simple. Whenever you are buying the futures, when you are taking a position, buy position, long position in the futures market, what you are actually doing now, you are agreeing to buy the shares, underlying asset on a given future date, which means futurely you are going to buy, not today itself. You are buying the contract today itself. I agree. But the underlying, when you are going to buy, tomorrow you are going to buy, which means today what you will do, you will sell the shares, which means cash segment, I will take a sell position. Are you listening? To take advantage of this futures, okay, futures arbitrage opportunity. If I want to enjoy the arbitrage profit, what I should do? When I have a long position in the futures market, the strategy is to sell spot. Are you understanding? You will sell the shares today. Tomorrow you are going to buy a futures, you are buying today, futures contract you are buying today, but the shares you are going to buy tomorrow. When you are going to buy tomorrow, what you will do today? You will sell the shares today. Are you understanding? Short sell the underlying in the spot market. We have two market. This is spot market, this is futures market. When futures market you are long, which means you are going to buy in the future. Today, spot what you will do? You will sell. Are you listening? When you are, when AFP, when the actual futures price is more than fair futures price, futures is overpriced, you will sell futures. When you are selling futures, you will be short in futures market, correct? You will sell futures, not short in the futures market. When you are going to sell in the future, what you will do in the spot buy. Are you understanding? This is the strategy. Upper sell futures and buy the underlying asset in the spot, correct? This, so profit will be here, the profit will be spot in fair futures price minus actual futures price. Here the profit will be actual futures price minus fair futures price. The S into 1 plus R is simple interest compounding, e to the power S, e to the power TR. This is nothing but FFP, fair futures price, and this is nothing but fair futures price. Okay. Say, when AFP is equal to exactly FFP, then there exists no arbitrage, which means quoted price in the futures market is as same as the fair price, which should have been the price now. So hence there is no arbitrage opportunity. This is called as no arbitrage price, fair price, correct? But sometimes what happens, in the borrowing rate of interest and the lending rate of interest will never be one and the same. Deposit rate and borrowing rate of interest will never be one and the same. Practically speaking, there will always be, the arbitrage will be boundary. Okay, there will be no arbitrage boundary and will not be a no arbitrage price. Okay, there exists only one no arbitrage price if both interest rates are same. But never we see practically both interest rates will never be same. If they are different, then there exists no arbitrage boundary, which means there will be a price range, not one specific price. There will be price range. If the actual futures price is less than this range, there will be arbitrage. If it is more than the upper range, there will be arbitrage. But in between these two values, if your futures is quoted in the market, then there will be actually no arbitrage. This we solve in the regular lecture. There is one comprehensive question. Okay, why these are different, how the boundary is formed, quasi arbitrage, all this we discuss in a regular batch. I don't want to discuss in here. Not much relevant in examination. Say next, futures arbitrage. Two questions we have. We will solve this and move on to the hedging, last segment, that is hedging. Okay, see here, futures arbitrage. Take this question for discussion. Following data relate to Anand Limited's share price. Current price per share is 1,800. 6 months futures price is 1,950. Assuming it is possible to borrow money in the market for transaction in securities 12% per annum. So rate of interest is 12%. To calculate the theoretical minimum price of the 6 months forward price. First step in computing the arbitrage is computing the fair futures price. Very simple. Yeah, current price per share is given. Are you understanding? So we need to compute fair futures price. Then we will find out whether there exists any arbitrage opportunity. Are you understanding? Seri. Inge, you see, fair futures price 1,950 is given. Okay, are you all seeing? Inge confused. There is spot price is also given. This is spot price, cash segment quoted price of the share. Are you listening? This is futures price quoted in the F&O segment. Okay, this is 1,950. Now, fair futures price, first step of while computing arbitrage, while calculating arbitrage or seeing the arbitrage opportunity, first you should compute fair futures price. Correct? Theoretical futures price you need to compute. While computing theoretical futures price, what you will consider? Futures price or spot price or spot price. Spot compounded to future. Spot 1,800 into e to the power TR you will use. E value given a normal compounding. Normal compounding. Nothing given. E value is not given. 1.06 because I think 12% per annum. Yes, 12% per annum. Okay, interest will always be given per annum. Okay, annual interest and 6 months. 6% per 6 months we will consider 1,800 into 1.06, 1,908. This is fair futures price. First step, fair futures price 1,908, which means this should have been the futures price. You compare it with what? 1,950. Are you all understanding? Don't get confused. 1,800 is spot price. That should not be taken for comparison. 1,950 futures price you will consider. This is the quoted futures price. You are considering fair futures price versus quoted futures price. You are comparing which is lower, which is undervalued, or which is overvalued. You see, futures price should have been 1,908, but it is actually quoting at premium price 1,950, which means futures are overpriced. Hence, we need to sell futures. This is spot, this is futures market. If you are selling futures or short, here you are taking a short position in futures market. Okay, what is the arbitrage? Here, what you will do in the spot market, you will buy a share in the spot. So, what is the strategy? Buy the share in the spot market, sell the futures in the futures market. Are you understanding? Short position in futures market, okay, long position in spot market, buy in spot market. So, fair futures price 1,008, actual futures price 1,008, the share is overpriced. in the futures market. Okay, share is overpriced in the future market or the futures is overpriced. Therefore, the arbitrage strategy is to sell the share futures contracted 1950 and buy the shares at 1800. Two things simultaneously you will do. What you will do, I just explained you. You will buy the share. This is buying price 1800. You will sell the futures 1950. Correct? Agreed? 1950? Yes, 950 actual price. Correct? Now, you tell me, when you sell the futures, that is right, 1950 I agreed. When you buy the 1800, correct? You need to have cash to buy. You will assume that you will borrow. Are you understanding? What you will do? Beggar, steal, borrow. Borrow. Up 1800 you will borrow, and okay, upon maturity, what you will do? Okay, you will make some profit in the futures market. That you will use and repay the borrowing. Balance amount will be the profit. This is the case when the shares are deliverable, when the shares are settled by way of delivery. In case when there is cash settlement happening, okay, P&L will be computed in some other way. I'll explain. No issues. Here, see. Here, arbitrage opportunity. How to compute arbitrage opportunity? Borrow 1800 at 12% for 6 months. Futures maturity period. Okay, you will borrow. What you should borrow? Whatever you will be your outflow in the spot, you should borrow. Which means you are going to incur 1800 to buy the share today. But 1800 you will borrow. At what rate? 12% interest rate for 6 months you will borrow. That is the future maturity period. For that period you will borrow. Now that will come. Now simultaneously you will sell the futures also at 1950. Correct? Now while during the maturity period, okay, or after the maturity period, what you will do? You repay the borrowing along with the interest. Appo 1800 if I compound it to future, I'll get 1908. Idila 1908 1800 will be principal which I need to repay along with the principal portion of 108. Are you understanding what I'm trying to say? This 1908 I need to repay. This is maturity value of the borrowing which you took initially to buy the share. Correct? Now what you should do? Sell the share in futures market. Futures, you agreed to sell the shares on that day itself. Correct? First day itself, you agreed to sell the share at 1950. Which means, when you are agreeing to sell the share as 1950, some other party will buy the share at 1950 by paying you cash of 1950. Which means, you will receive 1950. Agreed? You will sell the share and receive 1950. Up 1950 worth the share, you have already agreed to sell the share at 1950. You will sell the share on the date of maturity. You will realize 1950 cash. You will pay 1908 along with the other borrowing amount with maturity, with interest to the lender. Are you understanding? 1908 you will repay. The balance 42 rupees is the profit. Are you comfortable? How to compute this profit? Okay, this is if the delivery of this shares is taken. Okay, if there is no delivery now, what you will do? Net settlement will happen. On the maturity date, what is the futures price? You will see. Here, they have not given. That is why we are considered. See, 6 months futures price today. You tell me, children. Both the prices are quoted today, Even though this is cash segment, this is the price 1800. Futures price F&O segment, this is the price 1950. But futures counter sell when it is cash settled, net settlement. Futures on the date of maturity will be given some number that the difference will be settled way of P&L. Listening to what I am trying to say. In that case, okay, delivery will not happen. But here, since no data is given on the date of maturity, what is the futures price? Nothing given. We will assume that this is by way of delivery. The settlement happens by way of delivery. That's why you are borrowing 1800. You are buying the share, selling the futures at 1950. Then you are, taking the delivery of the share. Okay, you are giving the delivery of the shares and getting 1950 as cash. That you are settling, okay, the maturity value of 1908 you are settling, and the balance 42 rupees the arbitrage profit. Are you listening? What I am trying to say? This is nothing but, okay, this is the process. But simply speaking, the value 1950 minus 1908, 1950 is nothing but actual futures price minus fair futures price. This is what is the profit. Are you understanding? Simple terms, this is the profit. But arbitrage, how arbitrage will happen, the process I explained. Exam, you should write down the entire process. The borrowing and repaying will also be relevant. Are you listening? Next, one more question we have. Okay, here futures arbitrage on dividend paying stock. Calculate the price of 3 months PQR futures if PQR okay, quotes 220 on NSE, okay, face value is given, almost certain that they will give dividend also, correct? Yes. And 3 months futures quotes at 230, borrowing rate is given as 15%, annual dividend yield is 25% per annum, payable before expiry. Also examine arbitrage opportunity. Arbitrage, first you need to consider fair futures price. I have taken this question. What is the difference between previous question and this question? Previous question there was no dividend. In this question, dividend adjustment is there. With the dividend, okay, how to compute arbitrage we are going to see here. Here first step, fair futures price, spot price plus cost to carry minus dividend. Simply they have done the cost to carry method. Here dividend, they have converted, the yield is given, dividend yield is given, I think, or yes, dividend yield is 25% per annum. And I think this is annual dividend yield 25% actually is wrong. Annual dividend yield, the annual dividend is 25%, they should give. Dividend rate they should give, because yield it should be computed on market rate. 25% dividend yield will be, okay, interest will not be there. So what they intended to give you this as dividend rate, which you should apply in the face value 10 rupees. So 2.5 is the dividend. Are you understanding? See, entire 25% dividend is payable before expiry, which is 2.5, which means, yes, okay. Now what you will do is that fair futures price, spot price plus cost to carry minus dividend. 220 is there, plus cost to carry 15% into 220 into 3 by 12 minus dividend. Dividend 25% you apply to face value 2.5. You will get fair futures price at 225.75. Next, identification of arbitrage. This is fair futures price. Actual futures price quoted in the market 230. What is the difference? The difference is simply the arbitrage profit. 230 minus 225.75. 4.25 is the arbitrage profit. And after solving, okay, you will get, see here, 4.25. But how you will get 4.25? Okay, you need to show all these steps also. The share is overpriced in the future market, therefore the arbitrage strategy is to sell the futures contract at 230. Correct? Here there is cash segment, futures segment. You tell me, futures, fair futures price, yes. See here, fair futures price is 225, actual futures price is 230, which means actual futures price is more than fair futures price. It should have been 225.75. It is 230, which means futures overvalued. Something overvalued, now what you will do? You will sell. Futures you are selling, futures you are selling. For short futures position. Now cash market, what you will do? You will buy the share. Are you listening? The strategy is to, okay, sell the futures contract at overpriced 230 and buy the share at spot at 220. Are you listening? Now how the arbitrage process will happen? Very simple. Borrow 220. Now at 15% for 3 months. How much is that? Initial cash you borrow 220 na? Yes, to buy the share you borrow 220. Correct? This is outflow for you. Correct? Initial cash outflow for you. Next, take a short or sell position in the futures market of 230. Okay, there will be any outflow? Nothing will be there. Are you understanding? Basically, there will be no outflow. Today, you are taking short position. Technically speaking, some margin amount will be involved, but still, short position, no outflow. Assume. Receive dividend and repay borrowing with interest, which means dividend amount is there, okay, and you will receive the dividend. How much is the dividend is inflow? You will receive plus 2.5, that is the inflow. And repay borrowing along with the interest, which means borrowing 220k, 3.75%. Okay, annual interest is given as 15%. Yes, 15% annually, which means 3 months, 15 divided by 4, you will get 3.75. Correct? That 3.75, yes, 3.75. You will compound this, you will get 228.25. Simple interest, you just get 228.25. Understood? This is the repayment of the borrowing along with the interest. You will receive dividend as well as you repay the borrowing. Next thing, sell the shares at spot price, okay, at time T, which means spot on the date of maturity. T na here maturity. Are you listening? Okay, I am just illustrating. T na on the date of maturity, what you will get? Okay, you will get 230 ki, you will get the amount. Okay, you will get the cash equivalent to 230. Why? Because you are selling na. Already agreed to sell at 230. When the actual futures price is 230 quoted in the market, today na, on the initiation of the contract itself, you sold the futures na. You took the short position in the futures market. You sold it for 2000 na. Agreed to sell on a future date, but agreed to sell at 230, which means 230 will be your sale proceeds. Correct? 230 you will receive. Okay. Close the sell futures by counter buy at spot and book profit or loss in the futures contract, which means here, okay, minus 230 minus ST. Very simple, yeah. In a spot price on the date of maturity they are mentioning. Listening, 230 here, 228.25 na. See, repay the borrow. When see, very simple, yeah. In 230 you sold minus this is ST. Are you understanding? You get 230. This is the price at which you agreed upon already to sell the shares. Correct? Appa you sold the shares, you got 230 minus repayment of borrowing 228.75. The balance 1.75, 1.25, yeah. Yes, the balance 1.25, 1.75 up to 228.25. Yes, 228.25. The balance 1.75 is the profit. Correct? Here dividend is received. Up a total profit you have received. Okay, 2.5 as dividend plus 1.75 as gain in the buying and selling. Repayment you paid 228.75 and your sale proceeds is 230. Net gain is 1.75 and here dividend gain is 2.5. Ultimately the total net gain is how much? 4.25. This is nothing but difference between fair futures price and actual futures price. Are you understanding? Sorry, one understanding is that when the question gives you the dividend, see, I'll tell you one understanding is when the question gives you dividend, okay, which is to be paid before expiry, you will not again discount it. Are you understanding what I'm trying to say? When dividend is only, they have not given after how many days the dividend is being paid. In that case, you will not take any days for discounting. Dividend you will simply reduce. Upper spot plus cost to carry minus dividend you simply do. In the last question also, one of the question we saw that they have given simply before expiry. In that case you do like this. Are you understanding? Okay. But ideally, when dividend you are reducing from the spot, it is as good as, okay, dividend you are adjusting today itself, which means dividend is being paid today. Then the spot itself is ex-dividend price. Spot should be ex-dividend price. Let it be. Are you understanding? This is the understanding. Institute in the market, before expiry, if they mention, what you should do, you should not discount the dividend back. You should adjust dividend as such without discounting. Apo, what is the fair futures price? Fair futures price is equal to spot plus cost to carry minus dividend. That's it. Dividend rate is given now. You will just apply in face value and convert it into amount terms, rupee terms. You will convert and solve the question. Are you understanding? Sorry, with this we have done with the arbitrage process. Now we'll move on to the hedging process, hedging through futures. Okay, now we will discuss hedging through futures, the last topic of this chapter. See, what is this hedging? I'll tell you. There are three types of market participants. Okay, as you already know, say there are three types of market participants. One is speculator, then there is arbitrager, then there is hedger. Okay, see, speculator is a person who comes to the market just to speculate. He doesn't know, he doesn't care about risk at all. Okay, he doesn't know what will happen tomorrow. He just simply speculates about the prices, okay, and tries to benefit out of it. Are you listening? Next person, okay, the arbitrager, already we discussed arbitrage strategy. Okay, he tries to earn riskless profit through various strategies. Are you understanding? Okay, he tries to earn riskless profit. Then there is a person who is hedger, okay, who mainly focuses on risk management. Okay, all he wants is to manage his risk, which means hedger already he would have opened up a position. Okay, he would have a position. Then to hedge his position, he comes to this market and tries to hedge it. For example, he would have a position in cash market. Futures will be used where as a hedging tool it might be used. How? I will tell you. Okay, we usually have position in cash market. We will buy the equity shares. Correct? Okay, sometimes what happens during downturn, we might expect that the share price is going to crash. In that case, if we have, see, the cash market position, okay, generally for intraday purpose only you can take a short position. For long period you cannot short in the cash market. Correct? But generally there will be buyers in the cash market. Agreed? So when you buy in the cash market, you are fearful of, okay, price rise up, price decrease. Are you understanding? You are fearful that tomorrow the share price may crash. Correct? If share price falls, your investment will have loss. Correct? So in order to hedge the downside risk, what they will do, okay, they will come to futures market and try to hedge their position. Are you listening? Cash market, if you have buy position, correct, the share price is going to fall down if you have fear. If you fear that tomorrow the share price is going to depreciate. In that case, okay, you will take what position in futures market? You will try to take sell position, short position in futures market. Very simple, pa. I'll try to explain briefly here. See here. See, we have two markets. One is cash market, other is futures market. Correct? Now, generally cash market you have buy position or long position. Correct? Buy position in cash market, which means you have some shares, assume some shares of Reliance Limited. Okay, Reliance Limited, you own Reliance stock. Are you listening? Now you are fearful that since there is problem in Middle East, you are fearful that oil price, crude oil price might increase, so share price may drop tomorrow. Are you listening? Now what you will do? You are fearful of price drop. You will come to the futures market and try to hedge the position. I told you na. This we are discussing from the angle of the hedger. What hedger will think na? He doesn't care about profit. He is not coming into market, okay, to take benefit of the price difference. Are you listening? He is coming to market to hedge his position. Already he has an open position, he has taken a buy position. He comes to futures market and tries to hedge the position. Why? Because tomorrow he is expecting a price drop in share price. Now what you should do? You should ideally sell. Whenever you are expecting tomorrow the price is going to drop, today you will enter into a futures contract. Future is a contract whereby you agree to sell the share, but not today, for a future day. Are you understanding? Say suppose after 1 month you are expecting the price to drop. Here what will happen? Okay, the futures the price will drop. Are you listening? So in that case you will take a short position in the futures market. Short position in the futures market. You will short it. Why? Because this is nothing but agree to sell. Okay, sell in futures market. Sell you are going to sell in next 1 month period or 2 month futures, 2 month period. If you are expecting after 3 months, 3 months futures you will take. Are you understanding? So very simple, yeah. In a cash market, whatever position you are taking, opposite position you will take in futures market. Why? To really balance your portfolio, so that okay, here what will happen tomorrow? What will happen? Cash market, if as expected the share price drops, cash market, correct? Suppose 100 rupees was your portfolio value, it became 80 rupees. Here you will have loss of 20 rupees. Assume this is just crudely explaining. Okay, you will have loss to the extent of 20 rupees. Futures, what will happen? When there is a drop in cash prices, future is derived from cash market. So whenever there is a price depreciation, whenever there is a fall in share prices, automatically futures price will also fall. Not at the same rate, that I will explain later. Are you listening? Okay, futures price is very, very much dependent on the cash segment of spot price. Are you listening? When spot price is dropping, okay, for example, in the month it started with 200 rupees. Slowly it is dropping, assume. Okay, the futures price will also drop. Are you listening? But it will not be dropping at the same rate as spot price. Okay, on the date of maturity, convergence will happen. That you need to remember. So what will happen? Futures also, price will drop. Here, the point is you have taken sell position and not buy position. Since you have sold at 100 or whatever price it was here, 100, 1 or 2 or some prices, it may not be same, but initially you sold, okay, as and when the price drops, suppose 80, 85, some price, okay, if drops, in the future market you will have gain because you sold at a higher price and you are buying back at a lower price. Are you all understanding? Here you already bought, so price drop will give you losses. There in the futures market you already sold, so you will close your position by counter buy. You sold at 100, you will buy at 80. Okay, your position will be hedged. You will make a profit in the futures market. So loss in the cash market is offset by the profit in the futures market. But the profit or loss will not exactly offset. Are you listening? Because the futures hedging will never be perfect. Perfect hedging in the sense, if you have say 10 lakh value of your exposure in the cash market is to the extent of 10 lakh. In the futures market, okay, it will be, see, it will not be exactly 10 lakh. It will never, exactly offset the position. Are you listening? It will never be perfect hedge. Why? We have reasons. I'll discuss it later. Are you listening? Because the stock price and futures price are correlated, but not perfectly correlated, which means futures price is very much dependent on the cash price, spot price of the share. If a Reliance futures is very much dependent on the Reliance stock price. Are you listening? But the rate of change will not be exactly same. In that case, okay, there might be some difference. That is one reason. Secondly, not for all the shares in the stock exchanges, you have futures market available. Are you listening what I'm trying to say? I told you, I told you in the previous session. Okay, I told you na there it will not be available. The futures market will not be available for all these shares. Are you listening? Only for specific shares you have futures market, F&O segment is available. So in that case, what should we do? We will take index hedging. Na? I told you beta hedging or index hedging we need to consider. Appa when you are hedging your stock position, share position using index futures, okay, there will be, it will not be perfect. Are you understanding? Say, these are all the reasons which I will discuss. Now you listen, see here. 1 second. So we have to take opposite position. That's the understanding. Say when a person takes long position in cash market, he fears price decrease, and similarly, if he has taken a short position in the cash market, he fears price increase. Futures market can be used to hedge his cash market position and vice versa. Like that, okay, futures market, if there is a trader who is trading in F&O segment, he can take position in cash segment and hedge his F&O position. Are you understanding? Vice versa possible. His futures market position for hedging his cash market risk can be as follows. Long position in cash market can be, okay, hedged through, okay, short position in futures market. Same way, short position in cash market can be hedged through buy futures or long futures. Are you understanding? In the above case, if due to price change we make loss in cash market, it will be compensated through the futures market gain and vice versa. For example, say the price of share decreases and a person is long in cash market and has hedged through sell futures. His portfolio is protected. How it is protected? Na? Cash market you have already buy position. Correct? Spot price you will buy. Cash segment you will sell at future spot price. Adavadu cash segment whatever is the price future spot price, which means say after 1 month or 2 months, whatever is the spot price on that date, that will become your sell price. Are you listening? Not effectively, you may ask, sir, I am not at all interested in selling the stock after 1 month. I am long-term holder. Okay, I need not sell the share. But the P&L, yeah, that, okay, in your demat if you see, okay, there will be realized profit and unrealized profit. For the concept applies for both. Are you understanding? There will be P&L plus 10%. This will be given like this. Correct? How it is computed? See, for realized profit, now if you sell it, it will be realized profit. If you don't sell it, even if you don't sell it, okay, the current market price, the unrealized profit will be computed. Are you listening? So that is future spot price, you will sell. You need not sell, it is the current price. Correct? The difference will be your P&L. Maybe realized or unrealized, we don't care. Sorry, makes loss in cash market. Come to futures market, what happens? You take sell position, okay, in the futures initially. Later, you take a counter buy and close the position. Exit price, okay, the buy position, take it. Are you understanding? Books profit in margin account, which means makes loss in cash account, cash segment. Come to futures. Futures, you have profit, which will offset. Okay. If we have TCS shares in cash market, we should hedge using TCS futures. If we have Reliance shares in cash market, we should hedge using Reliance futures. This is a concept of index hedging. Now we are learning the concept of index hedging. See, I told you, not all the shares will have corresponding futures market. In that case, what to do? How to hedge my position? Question arises, na? That's why we have a concept called as beta hedging or index hedging. See this, we should hedge using Reliance futures and so on. This is because the movement of the prices in cash market will be correlated to the price movement in futures market, thus making the hedging effective. It should be noted that all the securities traded in the exchange need not have their futures contracted in derivative segment. In such case, we should use index futures for hedging. Okay. When we use index futures for hedging, the problem is that index movement and the share price movement will never be same. Are you understanding? Index movement and share price movement will never be same. Correct? Apo hedging, how to hedge the position. Are you listening? How to hedge our position? We should consider beta into equation. Okay, beta is a concept we will discuss in detail in the portfolio management. Okay, I will revise it. No, don't worry. I will revise it in portfolio management in detail. But just to understand the concept of beta, see, beta is nothing but the change in securities return, okay, by the change in market return, which means, see, what is beta? Beta is nothing but change in individual security return, okay, upon change in market return, which means beta captures the change in securities return, okay, for each percentage of change in market return. Are you understanding? Very simple, yeah. If beta is 2 times, let's go. Crude understanding, beta is 2 times. See, we will learn beta, everything in the portfolio management in detail. We have 6 formulas for that, correlation method, regression method. We'll do everything. Just now understand, okay, what is the meaning of it ultimately. See, suppose a market, index market, index, I told you, in the equity valuation chapter itself, I told you what is index. Suppose the Nifty moves up by 1%, the Nifty goes up by 1%, the individual stock is there, suppose Reliance, if we are considering Reliance, this Reliance or TCS shares, assume it has a beta of 2 times. What is the understanding now? Listen to me. If 1% is the change in market, if the Nifty goes up by 1%, Reliance will also goes up by, suppose beta is 2 times, okay, beta is 2 times, Reliance will go up by 2%. Upon Reliance share price, what is the, sensitivity of the Reliance share price, okay, upon the sensitivity of the market, which means what is the effect of the change in return for the security due to the change in market return. This is what beta captures. So yeah, when we use index futures for hedging, the problem is that index movement and the share price movement will never be same. Then how to make the hedge effective? See, even though there will not be perfect hedge, but okay, how to make the hedge at least near perfect we should make now? We should consider beta. Are you listening? We should use beta for hedging. Beta links the change in index to the change in beta. Okay, see here, beta links the change in index to the change in security prices. Change in security return or change in security prices return ultimately, okay, it will be taken from prices only, so change in, okay, security price divided by change in market return, okay, change in market price. This hedging strategy is called as index hedging or beta hedging. When we hedge using index futures, the value of the position to be taken in future market is as follows. See, you have 100 rupees cash market position, very simple, yeah. You have 100 rupees, you have bought Reliance shares worth 100 rupees. Now the Reliance beta is 1.2 times. Assume the Reliance beta is 1.2 times, which means in the futures market, how much position you should take? You should take a position of 120 rupees to compensate for this 100. Are you listening? Very simple, yeah. Futures market position is nothing but beta into cash market position value. Are you understanding? For what value? The value of the futures contract, okay, you need to trade, for the value of your trade will be what? Beta times the cash market value. Are you understanding? Simple equation. But beta you will multiply with the cash market position. Suppose you have 50 lakh position open in the cash market and you want to hedge through beta index futures. You want to hedge through index futures. You have taken position in individual share. You want to take position. You want to hedge this using index. Then what we will do? It has a beta. Assume this stock has a beta of 2 times. In this case, what you will do? Futures market. Okay, to compensate a 50 lakh of cash segment value, you have to take position in the future market to the extent of 100 lakhs, 2 times the cash market value. Are you understanding? Say, suppose cash market position was long shares, portfolio worth 10 lakhs. Example also I have given, please go through. Beta of the share portfolio is 2 times 1.2. Futures market, what we should take? We should take a position worth 12 lakhs and not 10 lakhs, because when the Nifty changes by 1%, the share will change by 1.2%. Correct? 1.2 times in this example, right? Suppose the Nifty drops by 10%. Okay, the share value will drop by 12%, not 10%. Apo Nifty drops by 10%, share value will drop by 12%. Apo to compensate a drop of 12% in the cash segment, are you listening? Okay, compensate a, see here, the share, Nifty of 10%, the share value drops by 12. The 10% change in 12 lakhs, the 10% change in 12 lakhs, which is 1.2 lakhs, correct, will help us to hedge the 12% change in 10 lakhs, correct? Net 1.2 lakhs is the difference. Are you listening? Okay, hence we should hedge beta times the cash market value in the futures market in case of index hedging. If we hedge the full beta, we will reduce the systematic risk to 0. See, risk is of 2 types. We will study in portfolio management. There we will discuss systematic risk as well as unsystematic risk, correct? Either systematic risk is a risk arising from the system itself. System in the sense, see, we have in the market itself. Okay, first the market itself, you need to understand systematic risk. There are so many theories. Okay, APT theory, systematic risk, market risk, not only market risk will be considered. Okay, the entire macroeconomic, all the macroeconomic factors will be considered. Like a systematic risk, macro risk factors are there, na? So they will be considered. Macro risk will be considered. But in the main theory, okay, systematic risk, na, generally you should understand it is market-based risk. Apo, very simple, yeah, to put it simply. See, if there is some interest rate drop, assume the market, RBI is coming with some significant interest rate changes. Are you understanding? If RBI comes up with some significant interest rate changes, now what will happen? Okay, the entire index may fall. During COVID, classic example, during 2020, COVID came na, up a lockdown announced, so all the businesses shut down. Up in that case, okay, everyone was expecting a recession. So what happened? Market fell like anything. Index dropped, so, okay, nearly 30%. Are you listening? From the highs. So what I'm trying to say is that in this case, if there is a factor like this, okay, COVID, suppose COVID came, due to that, entire index dropped, yeah, all the shares in the index dropped, correct? Nifty itself crashed. In that case, okay, all the individual shares will also drop, na, correct? Are you listening what I'm trying to say? So systematic risk, the risk which you cannot avoid, in the market risk we cannot avoid. Okay, all the shares will, feel the burn of it. Are you listening? You cannot escape from it. Unsystematic risk, it is a company specific risk which is diversifiable risk. That systematic risk, it cannot be reduced due to diversification. Very simple, yeah, I will tell you. If you have a portfolio, you are maintaining you have demat account, what do you do? Okay, Nifty 50, there are 50 companies, say Nestle, Britannia, ITC, all the companies are there. Okay, what do you do? Okay, you expect that COVID is going to come, lockdown is going to come, you have only ITC and Britannia shares, assume. Okay, what do you do? Quickly go to the market and try to buy Asian Paints, whatever in the balance Nifty 50, whatever stocks you have not bought, you are going and buying. Are you understanding? COVID came, okay, entire Nifty crashed. Will you escape? You will not escape. Are you understanding? So just because you are diversifying, diversification reduces risk, but it only reduces unsystematic risk, not the systematic risk. Are you understanding? All these things we will learn in portfolio management. There you will understand. Now just understand the entire risk cannot be reduced to zero by just participating in the market. Are you understanding? Market risk only can be reduced to zero. Systematic risk can be reduced to zero by beta hedging. For example, if the portfolio has a cash market value of 1,300 lakhs and a beta of 1.19, okay, this was taken from the question that I put it as example. Are you understanding? 1.19 like accurately, don't ask me. Just to put it for example. Okay, there is one question in the institute module. From there I have taken this. Are you listening? So 1,300 lakhs and a beta of 1.19. If we take a sell position, what we should do, what should be our position in futures market? Cash market position 1,300 lakhs into beta, okay, 1.19. If we take this value, so we are effectively reducing the entire risk, so which means beta was 1.19. From there you are bringing the beta to zero. Are you understanding? Question, yeah, why I am discussing is question might mention sometimes, okay, not to hedge your entire portfolio. Are you understanding what I'm trying to say? Which means if you bring the beta to zero, your entire portfolio will be hedged. The entire value of the cash segment will be hedged. Are you understanding? If you don't bring it, sometimes what happen, I may be open to keep my exposure open to 0.6 beta. Are you understanding? For example, question 1.2 is the beta of Reliance stock. Through futures hedging, reduce beta to 0.6, not 0. Are you understanding? In that case, you should not fully hedge the position. Apo, I should only reduce to 0.6, beta till 0.6. Apo 1.2 I will reduce my current beta minus the target beta into cash market value. I will get the required beta. Okay, sometimes question will mention you the beta, target beta, then will tell you that this is the current beta, you bring it to this much, beta to this much. Are you understanding? Say, suppose we want to reduce the beta not to 0, but to a target level, then futures market position value is current beta minus target beta into cash market position. Are you understanding? Okay, I'm detailedly discussing the concept first, question answers, so that question answers we can quickly move on to the question answers. All the different types of questions I put it, we can simply solve. Are you listening? Sorry. Next, if we want to increase the beta, it is also possible. Now there is a different question. See here, you told that we can reduce the beta. Can we increase the beta to futures hedging? Of course you can. Very simple, yeah. If you want to increase the beta, take same position, not opposite position. If you have buy position, double risk, yeah, are you understanding? Okay. If you want to see, you have a cart, Okay, you have a cart. Assume you have a cart and two sides you are putting a horse. Okay, one side there is a weak horse, another side there is a strong horse. You are putting in the cart and you are trying to reduce the risk. Adavadhu, one side there is a horse which is having substantial power, which is okay to reduce the risk, to reduce the speed of the horse. You are tying another horse, even though it is less what do you say, less powerful. Okay, you tied this side to reduce the risk of overrunning. In that case, okay, this is possible. Now, if you want to increase the risk, can you do it? Yes, I can do it. Okay, I can tie the second horse to the same side. It can go to the double speed, it can move. Are you understanding what I am trying to say? So you can easily increase the risk also. By what? Taking same position. Very simple. Inge cash market, here you have cash market, you have futures market. Okay, in the previous example, we saw that if you take the buy position in the cash market, you take opposite position to reduce the risk or manage the risk. Instead, I don't want to manage the risk. By reducing risk, if you are effectively managing the systematic risk, no, I don't want to reduce the risk. What I should need to do, you increase the beta. Appa double risk. Okay, double risk, very simple. Take same position. Okay, you increase the speed up of instead of putting a brake, you press the accelerator. Okay, futures market, you take buy futures. Okay, if you are long in cash segment, go to futures market, take another long position, your risk will be doubled. Are you understanding? Risk will be increased. You can increase that beta also. That is also possible. Listening, sorry, shall we do some questions? Before that, index hedging will not be perfect. I told you, futures hedging will never be perfect. That is what I wanted to discuss. With that, I will close the discussion here. See here. Yes, if you want to increase the beta, it is also possible through futures. When we take a position in futures market similar to the position in cash market, it increases the risk because it is either profit in both the markets or loss in both the markets. So, okay, risk will never be decreased, risk will be increased. Generally, futures hedging will not be perfect due to three reasons. This is the last concept you need to understand, that futures hedging will never be perfect. Okay, be it index futures, be it stock futures, it will never be perfect. The reason being, see, there are three broad reasons. See, cash market price and the future market of price underlying may move in the same direction. It will have correlation. Okay, yes, futures price is derived from the spot price. It will definitely have correlation. Which means if you notice in the market, I can, in the regular lecture I used to show it. Okay, if you see in the market, you can also see in the screener website, it will be available. If you see in the individual stock you take, ITC shares you take, and in the cash market, what is the movement you notice? Okay, suppose 1.5% today it appreciated. The share price increased. You go to the same corresponding futures market, the ITC futures will be there. Okay, you take whether 1 month future, 2 month future, 3 months future. Okay, any futures, there, if you notice, the futures price will also increase. Are you listening? Corresponding increase will be there, but not at the same rate. It will be some other percentage. That's where a percentage. It will not be substantially higher or lower. Are you listening? But there will be some increase. Either what will happen, daily there will be some changes. The changes will accumulate. Okay, there will be, changes will be more sometimes, changes will be less sometimes. It can happen. Say, it will be same direction, the movement will be in the same direction, but not perfectly same. Say, the correlation will never be perfect. This is important. Next point, in the case of hedging through index, now this is normal stock, or normal stock itself will never be perfectly correlated. Now come to, if you are taking index in hedge, not all the shares of futures market. If you take index for hedging, the beta only hedges the systematic risk. Still the uncorrelated movement of the stock price to the market index is never hedged. Are you understanding? Beta hedging, even if you consider, even if the question mentions perfect hedge, but still it hedges only the systematic risk and not the unsystematic risk. Are you understanding what I am trying to say? It will never be, the risk cannot be perfectly reduced to zero. Why? Because, okay, it will still reduce the systematic risk, but unsystematic risk will never be reduced. Beta will only capture systematic risk. Are you understanding? That is the point. Due to the standardized contract size. The main issue is the standardized contract size. Yes, you have cash market position. There assume you have a value of 5 lakhs. Now I told you, whenever you are coming into futures, minimum value is 7 lakhs. There will be difference in value because of the contract size. Futures will always be trading in lots, not like individual shares. If you go to US and all, okay, foreign country, the shares itself will be trading in Okay, fractions, we will call it as fractions. They will be in one share. Okay, Berkshire Hathaway, one share cost millions. Are you understanding? Okay, you go and check in the Google, Berkshire Hathaway, Warren Buffett's company, one share price, you just check it. Whether everyone will have that much wealth to invest? No, they will have class A, B, C, large. Okay, like the fractions of shares. You can even buy fractions of shares, just like mutual fund units. Units in mutual funds can even bought in decimals, fractions of share, like that. Okay, so due to the standardized contract also, it will happen. All these things I have given. Quickly moving on to the questions, we'll finish it off. Okay, shall we? Okay, see, very simple. We'll start from simple questions. Which position on the index futures give a speculator a complete hedge? See, a speculator will never hedge generally. Okay, given the question, speculator, okay, will never care about hedging. Yeah, are you listening? Say, a complete hedge against the following transaction, no issue. Index future he is using, that is the main observation. Say, share of the right limited, this is the individual share, right limited company, is going to rise, which means he is expecting a price rise. Apo, see, he has a long position in the cash market. They have openly told that in the cash market, he is longer. Okay, and he is expecting a price increase. Are you listening? Okay, he has long position in the cash market, 50 lakhs. The beta of this right limited is 1.25. Now he has to hedge the position. He is feeling the price might increase. Correct? Apo, okay. What is the position to be taken? You tell me. He has a long position in cash market. Simple. He has to take short position in futures market. Correct? He has to take short position. Now how much you short position? 50 lakhs. 50 lakhs into 1.25. How much is that? You get the answer. See here. 50 lakhs, 1.25. The trend is rising, so the position in the futures market will be short. Are you listening? Say, the trend is generally okay, is going to rise, but he will position for that. He will try to hedge for the adverse position also, That is why he is taking a short position. Listening, say. Next, come to second part. The share of wrong limited is going to depreciate. He has a short position on the cash market. Okay, he has a short position. It is going to depreciate. In the case futures, what should we do? He should take a buy position. The beta of wrong limited is 0.9. Up, see here. Okay, 25 lakhs is there. 0.9. You will get 22.5 lakhs long position. Just to take opposite position. Are you understanding here? Okay. Reducing beta, opposite position you should take. Share of fair limited is going to be stagnant. He has a short position in cash market. Beta of the fair limit is 0.5. Apo 20 into 0.75. Are you understanding? See, is going to stagnant, is going to rise, depreciate, it doesn't matter. See, you expect something, that is a different thing. Current position, if you want to hedge, you should take opposite position. Are you understanding what I am trying to say? See, current position, if you want to hedge, you should take opposite position. Okay. Now, there might be a situation where you may expect something, the reality might happen something else. Adhanadana you are hedging. Are you understanding why you are hedging? In case your expectation, you are expecting that you will get 80 above, correct? In the examination. But adverse case, at least you should get 50-60. Okay, you should have plan B to get 50-60. Are you listening? Same way here also. Okay, third, another fair limited, stagnant 20 lakhs, 0.75, long position. Here, short position in cash segment, long position. Now, what is the entire, okay, the portfolio value, 25 lakhs is there. Are you understanding? See, 60 to 50, okay, is the short position in case of first transaction. Okay, this is a NIFT. See, idalla individual share ki you will compute 50 lakhs, okay, 25 lakhs, 20 lakhs. Individual share will have individual beta. That's why we cannot cumulatively add that and multiply. Are you listening? But what we will do is that net position we need to show. If 50 lakhs you have net short position to the extent of 62.5 lakhs. Next you have a long position of 22.5, 15. Upon 22 plus 15, please, 22.5 plus 15. How much is that? 37.5. This you should, this is the long. Apo, you have 37.5 lakhs value, long position. Correct? Long position value na 37.5 lakhs. Short position value is how much? Short position value is 62.5. Net position is what? Short position to the extent of 27. Are you 25? Are you understanding? 25 is the net short position. You can show it or not necessary, but I am telling you. Okay, another question is, yes, Ram, this question you need to show. That's why I discussed like that. So yeah, see, Ram buys 10,000 shares of X Limited as a price of 22, whose beta value is 1.5 and sells 5,000 shares of A Limited at a price of 40 per share having a beta value of 2. He obtains a complete hedge by Nifty futures at 1,000 each. This is the Nifty futures price. Are you understanding? Lot mentioned. Okay, they mentioned lot. Not mentioned. Okay, no issues. See, the futures price is 1,000. Okay, now what we will do, X Limited first, Nifty hedging, see here, question we will complete first. He closes out his position at closing price of the next day when the share of X Limited dropped by 2%, share of A Limited appreciated by 3%, Nifty futures dropped by 1.5%. So, three things is that. See, in his portfolio, this is his portfolio, Ram's portfolio, we have X Limited, yes, X Limited, then we have A Limited, Syria. This is a cash market portfolio. This is futures market. Okay, futures market here Nifty futures index futures. Correct? Now we will move on to the details. 10,000 shares he has bought at 22. Okay, beta value 1.5. I'll come back to that. That is relevant for computing corresponding futures position. Cash position you have 10,000 shares into 22, 2,20,000. Agreed? Now, A Limited, this is short position in A Limited. Up 5,000 shares he took short position into 40 rupees is the selling price at which he, the price at which he shorted. Up 2 lakhs is the value. Correct? Now, see index the corresponding position we need to take. First one, for X Limited, how much is the value you should take? 1.5 beta multiplied by 2,20,000. Up 2,20,000 into 1.5. 2,20,000 into 1.5. This is 3,30,000 short position. See, yes, short position you need to take. Correct? Apo 3,30,000 you need to consider. See, just taking opposite position only is not relevant. I told you, you need to see whether he is trying to decrease his risk or increase his risk. That also is dependent on that. Are you listening what I am trying to say? Seriya? Okay. Next to see, the position is 3,30,000. Ideally, if you notice, 2,20,000 is the value. But since the stock is more risky than the market, beta is 1.5, you need to take 3,30,000 in the market. Adavade market index you need to take a short position to the extent of 3,30,000. Then come to A Limited. Here short market position is 2 lakhs. Okay, into beta times 2 lakh into 2, 4 lakh you need to take long position. Are you listening? Say. Now, short position 3,30,000, long position 4 lakh, upon net long position in the index is how much? 70,000. Are you understanding? Upper RAM has to go long on Nifty futures contract for a value of 70,000 because we net it off futures contract. We net it off on net position enough. Are you listening? Net position enough. Okay, because here if you incur loss, correspondingly it will be managed by the futures market. Listening? So only you net it off and 70,000 is the only you need to take position. This futures price is 1,000. They have mentioned. How many contracts you need to buy? First step is 70 contracts you need to buy. Understood? The position is 70,000. Total value of the futures market is, net value of futures market is 70,000. Exposure divided by 1,000. Nifty futures price is 1,000. So 70 contracts you need to trade. Correct? 70 long position you need to take in the futures market to the extent of 70 contracts. Now come to gain or loss. Profit or loss you need to compute. Here what they have done during the maturity period, they have specifically told the appreciation of the shares value, depreciation of the shares. See here, share of X Limited dropped by 2%. Apo he bought it for 40 rupees, 22 rupees na. Yes, X Limited 22 rupees na. It is dropped by 2%. Apo 22 la 2%, 98, 22 into 98%. What will be the share price? See, opening position the share price was 22. He bought it. Now, okay, he has taken long position. What happened? Closing la he will sell it cash market la. What happened? It dropped by 2%. Apo what is the value? Share price in a 21.56. 22 became 21.56. Gain or loss? He was long. Then he had to buy at a higher price. Have to sell at a lower price during in the maturity period. Correct? Apo what is the loss? Please tell me. 10,000 into 0.44. This is 4,400. Are you all understanding? First, next, A Limited. Come to A Limited. A Limited, he has taken a short position to the extent of 40 rupees. Okay, it appreciated by 3%. See here, shares of A Limited, okay, appreciated by 3%. In that case, okay, you will have loss again, still loss. Why? Because he has taken a short position. He has sold at 40 rupees and share price appreciated. Even on a Durbhagyam pare, see his luck. Taken a long position, that share decreased. Taken a short position, that share increased. Okay, and the price went to 41.2 and loss is to the extent of 6,000. 5,000 into 1.2, that is 6,000. Up a total loss in a 6,000 plus 4,400. 10,400 is the loss in the cash market for this person. Correct? Now come to Nifty futures. Nifty futures la enna arudha? Okay, Nifty futures la adiliyavadu at least profit we will see. Nifty la he has taken a long position. Correct? Nifty la he has taken a long position. Now what happened? He will close by counter sell. He has taken a buy position. Now he will close his position by counter buy at what rupees? Nifty futures is dropping, appreciating. Nifty futures is appreciating by 3%. Are you all understanding? Nifty futures, to our surprise, Nifty futures is appreciating or depreciating. See here. Where is that? Oh, sorry. Nifty futures is dropping by 1.5%. It is okay, reducing by 1.5%, which means 1000 into 95.5%, 98.5%, which is 985 rupees. Appo ingeyum, okay, Durbhagyavashad, he is losing, he is incurring loss. How much is that? 70 contracts into 15, loss is 1050, the total loss is 11,450. Now a question will arise, sir, you told that future will be a hedging strategy by reducing corresponding position, beta reduced, okay, the loss will also be reduced, sir. Why it is, magnifying? The loss in the cash market position was only, what is the loss, pa? What is the loss? 10,400. The loss in the cash market was only 10,400. To our surprise, the loss in the future market is 11,450. The futures market is even, 1,050, and it is even increasing. The overall loss is increased. Okay, it is not reducing. Why is it so? Question arises, na? This is because of the index hedging. I'll tell you why. See, I told you, not all the stocks have futures. Correct? Idhil enna problem varuduna? Sometimes you take some stock outside the index. Are you listening? You take various positions in the stocks outside the index. Correct? There are 5,000 odd stocks listed in BSE. Okay, Nifty index, only 50 stocks constitute the index. Balance stocks are there. It might appreciate or depreciate. It might move against index also. It is possible. Are you listening what I am trying to say? If Reliance Futures is taken as hedging tool for hedging the cash position of Reliance company, Reliance shares, in that case, you may say that, okay, it will be correlated, but not perfectly correlated, it will be correlated. We can say that. But the problem is, when you take index futures for hedging, okay, the outcome is totally uncertain. Okay, the outcome is totally uncertain. It will depend on, various other factors also, which means it will depend on the company, okay, which may form part of the Nifty or may not be. Are you listening? In case if the entire index is dropping, generally every share will drop. But based on the earnings, the share price might appreciate also. Are you listening what I am trying to say? Very simple, entire index is dropping. Economic condition is bad. But assume there is a hospital company. The hospital company will never run into losses. Are you listening? The profit will keep on appreciating. Okay, assume the share was undervalued today. The share price might increase. Are you understanding? This is possible, perfectly possible. So not every time when index falls, all the stocks will fall. There is no condition. Are you understanding? Generally it will fall, but there is no condition. That's why, okay, there might be a situation where you might be even, increasing the loss. That's why, okay, if you see legendary investors like Warren Buffett will never use, F&O contracts as a hedging tool. The derivation, the diversification, the reduces risk, all the theories are there, he doesn't agree. Okay, diversification he will call. Okay, he doesn't agree the concept of, diversification itself. There are two theories. Diversification reduces risk. Okay, there is a theory, but there are certain set of people who, investors, great investors, they believe that diversification will never reduce your risk. Risk arises from something which you don't know. They say that risk arises from doing something which you don't know. That's how risk arises. If you try to invest in, just for the sake of diversification, if you invest in 10 other companies, it will never reduce your risk. Because, okay, you are not studying and you are not analyzing the company, and just for the sake of diversification, you are buying the stock, and how it will reduce the risk. Are you understanding? If you don't know the promoters, okay, tomorrow they may run away. Okay, say there might be so many issues in the company. Audit report, adverse opinion is given. You have not analyzed anything. You just bought the shares. Will your risk be reduced? Never reduced. Are you understanding? So this is diversification is a tool, okay, for ignorance. if you don't want to do the hard work, okay, you can simply diversify for the sake of diversity. You can have hundreds of shares. Okay, what is the understanding now? If 20-30 shares tomorrow is worthless, still remaining 70-60 shares will, okay, protect your portfolio. This is the understanding here. But what I tell now, why you are bringing in 30 shares, additional shares in the portfolio, if you did not analyze? Okay, without analyzing, you should never add even one stock to your portfolio. That is what we'll do. Say next question. All this come to next question. Question number 40. Okay, come to question number 40. On January 1, 2013, an investor has a portfolio of 5 shares given below, security A to E given, price of the security given, shares given, number of shares given, beta value given. This is all cash market prices and beta value given. Cost of capital 10% per annum, which is to be taken as risk-free rate for the futures price. Correct? You are required to calculate beta of the portfolio. Portfolio beta, we are going to study in portfolio valuation, but still very simple thing. Portfolio beta is nothing but weighted average beta of the individual securities inside the portfolio. What is portfolio beta? Is nothing but weighted average beta of the individual securities inside the portfolio. Here market price is given, number of shares is given. So market value weights you will consider. In the cost of capital chapter in the intermediate, you will do book value weights, market value weights, okay, WACC computation, like that. Here also, contextually you need to understand here market value is superior. But here market value weight you will consider and find out beta. Are you understanding? Say. First step to compute beta, that we will compute. See here, security A, B, price of the shares, number of shares is given. You will find, multiply A and B, you will get the value of these shares. Correct? Total value is 1,88,000. You will find the proportion. Proportion in the sense, okay, the weights. Proportion is nothing but weights here. Okay, this is the weight. This is the beta of the individual security. Okay, this is weighted beta. Total weighted beta is how much? Sigma weighted beta is how much? 0.849. This is the portfolio beta. Portfolio beta is nothing but weighted average beta of the individual securities forming part of the portfolio. So I found out the portfolio beta as 0.849. Why we are discussing portfolio beta? I'll tell you. Till now we saw that questions, individual securities you take position in the cash market, you are hedging through futures market. Correct? Now there might be a situation where you want to hedge your entire portfolio. Correct? Portfolio will have individual shares in it, but I want to hedge my portfolio as a whole, not individually each and every security. Are you understanding? I want to hedge my portfolio in a cash market portfolio. Are you listening? In the demat when you open, there will be so many shares. It's a cash market portfolio. This you want to hedge through F&O. Correct? That you want to do. In this case, portfolio beta is 8.49. Same step is, see, the hedging process is same, which means the position, the value which you need to take in the futures market will be same. But only difference is individual portfolio, instead of individual portfolio beta, you just replace it with individual share beta, you just replace it with portfolio beta. Are you listening what I'm trying to say here? Upper futures market position is nothing but cash market portfolio value into beta of portfolio. Are you listening? Say. This is the next theoretical for part 1 finished. See here, part 2 the theoretical value of the Nifty futures for February 2013 they have asked. Inge we need to see what month they have given. January 1st. January, February ending 2 months futures. This is 2 months futures. They want to price. They want to find a value. Yes, theoretical value. Theoretical value is fair futures price. We compute a spot into e to the power TR. That we need to find out for 2 months future. We need to find out. Correct? Next, the question will arise. Nifty spot they have not given. Correct? There is a problem. In the question, problem? You see, carefully observe. They have not given the Nifty spot. See, Nifty futures. You need to find out 2 months futures. They are asking to find theoretical value of Nifty futures. Nifty futures derives its value from Nifty spot, Nifty points. Today, what is the Nifty point? That we need to consider spot into e to the power TR. We need to compound. Correct? They have not mentioned. Till now, they have not mentioned. But irony is that part 3 they have given Nifty, current value of Nifty. Are you understanding? That you should consider. Ideally, they should have given Nifty value. But no issue. Current Nifty, we should assume that, okay, Nifty is trading at the same price. That's 5,900. We will consider. Understanding what the problem is, Nifty futures when they want to value, okay, before this they should have given the Nifty points. Current spot Nifty they should mention. But they have mentioned in the third part. We will consider that. So 5,900 into e to the power TR. 2 months we will consider and risk-free rate we will consider and find out. Very simple, yeah. Here, see. Okay, one more thing, one important adjustment. Okay, right. See, so what you should do, 5,900 into e to the power tr you need to find out. Inge e to the power tr la t is 2 months 2 by 12 you will consider. Rate is 10.5% rate is given per annum. But there is a catch. What is the catch? Inge the rate is not continuous compounding rate. See here, the rate given is normal rate. Why? I'll tell you. Inge ln value is given instead of e value. Are you all listening what I am trying to say? See, okay, they have not given e value here. Ln log normal value of 1.105. They have given the log normal value 1.105 is equal to 0.0998. What does it mean? I'll tell you very simple. Okay, see here, I have given here notes, you can simply understand. Yeah, cost of capital is 10.5% given in the question. Okay, cost of capital is 10.5% given. Now, is this the continuous compounding rate, interest rate, or continuously compounding interest rate, or normal interest rate? We need to see annual compounding rate, we need to see annual rate. Annually compounded rate of interest. Cost of capital, annually compounded rate of interest only given. Continuous compounding rate of interest is, okay, this is 9.98%. 9.98% can also be, referred 9.98% can also be put as 0.0998. Are you all agreeing? Correct? The point is, what is the ln value given? What is the relationship between e value and nl value? You need to understand. Okay, if you are comfortable with maths, no issues. Sometimes students come from science background, they might have some difficulty. See, any number you have some e value e to the power r, assume, is x see here, e to the power x is equal to some number, correct? Suppose e to the power x or e to the power r because that is rate e to the power some rate, okay, is x okay, the rate at which the compound you are continuously compounding that rate is nothing but, okay, ln value of x. Are you listening what I am trying to say? See, e to the power 10.5 we need to find some other number, a continuous compounding rate, but that rate is not given in the question. Normal compounding rate is given, correct? See, inge parpa e to the power r is 1.105. So r is log normal 1.105, 9.98%. In other words, e to the power 0.0998 is nothing but 1.105. Agreed? How it is to elaborate in relation to interest rate, when we invest 1 rupee at 10.5% for a year normally compounded, okay, if you invest 1 rupee at 10.5%, the next year maturity value will be 1.105 if it is compounded normally. Are you understanding? Not continuously compounded. If it is compounded once, it will become 1.105. Agreed? But if the same rupee 1 is invested, but at not 10.5% annual compounding, but interested at 9.98% compounded continuously. We have quarterly compounding, I showed in a time value of money, quarterly compounding, half yearly compounding, quarterly compounding. Like that, if you reduce the frequency and you reach till continuously compounding, very simple, when you want to continuously compound, even at a smaller rate, it will become the equivalent amount of the normal compounding. For example, 1 rupee matures to 1.105, correct? But this 1.105, if you want to maturity value, if you only compound once annually, then the rate of interest should be 10.5%. Annual rate of interest should be 10.5%. But same 1.105 if you want to have a maturity value, but if you are continuously compounding, okay, the rate of interest will be even lesser than 10.5%, which means 9.98% is enough if it is compounded continuously, so that the maturity value will give you equivalent interest of 10.5%. Are you understanding? Equal annual interest of 10.5%. So to put it simply, okay, when we invest 1 at 10.5% for a year compound, it matures to 1.105. If the same rupee 1 is invested at just 9.98%, but continuous compounding, if it is done, then the maturity value will become same 1.105. One line summary of the entire discussion is, okay, e to the power, okay, in the question they have given annually compounding rate of 10.5%, not CCRRI like in the previous question, correct? If that is the case, what you should do, annual rate you should convert into continuous compounding rate. How to do it? Question, if they give e to the power value, right, you can consider directly that. But they have given log normal value. Whenever they give you log normal value, very simple, any number log normal value of 1.105 na, okay, continuous compounding rate in artham. This is given as 0.0998, which means effectively, okay, we should take e to the e value la, we should consider e to the power 0.0998 and compound. Are you understanding? Have they given e to the power 0.0998 value? Not given. Appa e to the power 0.998 you should consider that is the rate of interest. Inge e to the power TR is there na, the rate is 0.0998. Just now we found they have given in the question itself that rate we should take. We should take continuous compounding rate. T the T is time 2 months are 2 by 12. Appa please take your calculator. 2 by 12 into 0.0998. How much is that? 2 months up. How much is the amount? See, 1 second. See here. Yes, in the day, correct. They have taken, not 2 by 12. That is a rounding of 58 days they have considered. Very simple, yeah. They have considered days. Where the question is given to consider days instead of months. Yes. Sorry, my mistake. They have given days now. Number of days in a year to be treated as 365. They have given. So 365 days na full days should be given. Whenever they give you 365 days na, okay, you should consider each and every day. Up January 1 lende you will consider till February na. February, this is what year? The question they have given February 2013. Leap year only, nothing is there. So 58 days you will take. Okay, not the starting date. So 58 days you will consider. Okay, and you will do here. See here, upper 58 by 365 will come to 0.1589. Upper T is equal to 0.1589. 0.1589 into rate. Rate is just now we computed 0.0998. Okay, continuous compounding rate you should consider is equal to 0.0158. This is what is given in the question also. Can you see this? Then they have given this, mentioned this also. You may be wondering from where this number came. Are you listening? Okay, this came from this e to the power TR value. TR value then we got the number. Okay, futures price just compounding. They have taken this number, just replace the number, you will get fair futures price. Now next question, number of contracts to hedge the portfolio fully. Okay, see here. Next part, the number of contracts Nifty the investor need to select the full hedge until February. Current value is 5,900. Okay, they need to mention the index value earlier itself. Okay, no problem. We will consider now 5,900 is the current Nifty price. Nifty futures is 200 units. Assume that the futures are trading in the fair value. Are you understanding why this adjustment is given? If you are all focusing this point, this line, why they have given see, futures hedging when you want to do, you should take futures price. Agreed? Very simple, yeah. Futures value is there. Futures value is equal to nothing but futures price, correct? Into lot size. The 200 units they have given, correct? 200 units they have given. Futures price into 200 only you should get ideally the futures value to hedge, correct? In futures price given in the question, spot price of the Nifty given, Nifty futures given in the question anywhere, not given in the question. Are you understanding what I am trying to say? Nifty futures price is not given in the question. Only spot Nifty is given. In that case, what you should do? Okay, you should consider, okay, we should consider the fair futures price to be the actual futures price. A quoted market price, okay, a quoted market price is assumed to be same as fair futures price. That is what they are telling. Are you listening the importance of this? Without solving step 2, the understanding is without solving step 2, you won't get the input for step 3. What is the issue? You need to understand. Step 2, you need to find theoretical value, fair futures price. But if they have given the futures, quoted futures price in the third segment, in the question, you will get 2 marks for this without solving the second question. Are you listening what I am trying to say? Okay. See, even without solving the second part of the question, third part of the question, okay, you can solve it. Listening. Okay, because you will consider futures price. If futures price is given, you will consider that you have given the lot size. What you will do? You will consider that in total value to be hedged. You will consider using portfolio beta, correct? Cash market position already given in the question. So you cash market value they have given na. Yes, you will find out the price into shares total. You will find out value, correct? Now the point is that's why they want you to solve a theoretical price. If you make mistake in the second step na, you will not get marks in the third step. This is the importance in this subject. Okay, in this entire subject, it is very important to carefully observe each and every points because it is step one by one you should solve. If one mistake you commit na, the solving the question will never take in the time in our subject. Okay, it will hardly take 10 minutes to solve the entire question. Are you listening? But one small calculation mistake, some mistake happened in the theoretical price, all the other parts will be, gone. No marks will be awarded. That is the issue. Say, come back to the question. So we need to find number of contracts to be traded, correct? Number of contracts he needs to sell. Why he needs to sell? Question arises na, because he wants to hedge cash market la buy position. He has a cash position na. Okay, he has taken the portfolio la cash position is this much. Okay, long position. So he wants to take a short position in futures market. How much is to be taken? First step, see here, when portfolio is to be fully hedged, it means our target beta for the portfolio is 0. Since the investor has long position cash market, take short position. And how much is to be taken? 0.849 minus 0 na entire beta. Up 0.849 into cash position portfolio value. Portfolio value 188 lakhs, 1.88 crores. Some number we got na. From where this is the value total. See, sorry pa. This is the total portfolio value. Are you listening? Okay, this is the portfolio value into beta. You will get the futures contract value is 160 lakhs 7,776. Are you understanding? Divided by the theoretical value which you computed. This ideally should have been divided by actual futures price. Okay, actual futures price. Okay, value will be taken by actual futures, right? The question, since they asked to assume as actual prices, fair futures price, we have considered fair futures price. Is equal to 2,670 Nifty or 270 by 200, 14 contracts. Number of contracts, it will be traded in lots. 200 lots should be considered. Divided by 2670 divided by 200. If you do 13.34 decimals, the futures, you will round it off the next value. 14 contracts you will take. Are you listening? Sorry. Number of contracts to hedge the portfolio partially. Next step, what they are asking, this is to hedge fully. Partially, they asked us to hedge number of futures contract if he decides to reduce the portfolio only to 0.6. Are you listening? The earlier segment I told you na, a question might mention you have to reduce the portfolio to some target level, not fully. What you should do? You should take 0.849 beta of the portfolio minus target 0.6. That only you should take position in the futures market. Only till that you need to do risk management. You will not manage the entire risk. Are you listening? You will keep 0.6 risk as such, correct? Balance you will hedge. See here, given go through portfolio 188 lakhs into 0.849 minus 0.60. The balance portion only you will consider the beta and hedge. The total value of to be hedged is to be sold. The futures value to be sold is 46,94,860 divided by futures price. It will give you 783 Nifty. This is 783 Nifty. But divided by 200 again you need to do lot size. It will only be traded in 200 units. So number of contracts is 4 contracts. Are you understanding? 3.92 over rounded off to 4 contracts. This is listening. Say. Next question. Quickly I'll just discuss in the question, the same question as the previous question. I'll just discuss the difference in the between the previous question and this question and more. Portfolio beta will remain same. Market price given, number of shares given, values given, portfolio value. Okay, this is beta value. I should have mentioned the beta value. Maybe some printing mistake, maybe, I don't know. This is a beta value. Okay, and we need to find portfolio beta. Cost of capital given for the interest 20% per annum continuously compounded. Are you listening? Inge they have given see here. They have given LN value, not given the LN value. Are you all understanding what I am trying to say? In the previous question, compounded annually in the institute, when they want to screw you, okay, they will frame questions like this. In the small adjustments, they will play. Are you listening? If there is nothing to play, in the many questions, they will coin. Either continuously compounded, they have put. Previous question, they have put annual compounding and LN value given. And you need to know the relationship between the continuous compounding and annual compounding, how it is E value ko log normal value how it should be find, you need to know the relationship. Are you understanding? Anything okay in the say next the investor fears a fall in the prices of the share in the near future. Accordingly, he approaches you for the advice to protect the interest of his portfolio. You can make use of the following information. Current Nifty given, see inge per clear current Nifty is given 8500, not 8.5, 8500. Nifty futures lot size given. Futures for May currently quoted at 8000. June is quoted at 8000. Appo May futures quoted price. This is quoted price. Actual futures price, not fair futures price. Other we need to compute. For quoted futures price 8700 they have given. 8850 they have given. Now beta of the portfolio, you do it. Okay, see here. The previous beta of the portfolio same. Here what they have done now, here they have taken total divided by the value of this okay, the beta computation, different method they have used to compute beta. You will arrive at the same beta. See here what they have done previously in market share total value they would have given, proportion inge compute pannada, beta they have directly taken, value into beta they have given, then they have added this total they have considered, then divided by okay the market value of this portfolio. Are you understanding? Using this method also you can find out the beta. Say next the main point I wanted to discuss in the question nana, e to the power tr they have given, carefully observe theoretical value of the future contract they want to find out for May future, June future. Inga I want to clarify May futures na currently is what is this month on April 1. Appa May futures na 2 months okay, given anything about days, number of days given not given. Appa you will consider 2 by 12. 2 months futures, 3 months future na 3 by 12. 3 by 12. Are you all understanding? Say now May futures na 2 months na 10.5 is given na rate. Yes. Appa e to the power tr la I want to discuss something. See here. E to the power tr la t is 2 by 12 into 10.5 ya. Appa 0.105 na. See. 10.5% na 0.105. Agreed? How much is that? Please tell me. 0.105 into 2 by 12 comes to 0.0175. 1 second. Month, sorry, May month. Yes, May months na. Yes, 2 months future you want to compute. Okay. 20%, sorry. Okay, 20% given, 10.5. Okay. Sorry, this question, previous question, 20% given. Okay. 20% given as compounding rate. Okay, so we will consider 20%. So this is 0.20. Correct? Up 0.20 into 2 divided by 12. How much is that? 0.0 e to the power 0.0333. Are you understanding? Are you getting the e value? This is what we need to use and multiply to spot to get the compounded value. Future price, correct? Fair futures price. The issue in the question mentioned gives you e value. They have given, see another type of playing. They are playing games with you. E power 0.03 given, e to the power 0.04 given, e to the power 0.05 given. In this question, you have to find e to the power 0.0333. See, you have a calculator ready-made how to compute time value of money. First segment, I have discussed how to compute. No issues if you have calculator in hand. You don't need question to mention e value itself. But what institute has does na, this is a game. Okay, you need to do interpolation and find out 0.033. Very simple. Yeah. Next, I'll come back to this. June futures, 3 months futures is there na. 3 months futures. Okay. See here, 3 by 12 into 0.2 you do. 0.2 into 3 by 12. How much is that? 0.05. For May futures, you need to consider e to the power 0.033. June futures, you will need to consider e to the power 0.05. Either ready-made or given. You will consider as it is. Are you understanding? But in the e to the power 0.033, they have done interpolation by taking e to the power 0.03 value and 0.04 value. See. Point e to the power 0.033 comes in between, okay, e to the power 0.03 and e to the power 0.04. Okay, the e to the power 0.03 you have value na. Next, 33% of this value will be, okay, the 33% of this value we need to add to 0.03, or you will take e to the power 0.04 value and reduce 67% of the value from that. Are you listening what I'm trying to say? It is coming in between. See how they have done. I will show you. Okay. See, 8500 into e to the power tr. This is what they have given. Now e to the power shall be computed by using interpolation method. Okay, calculator use panla. Interpolation method la how they have given. They think that okay, they are the only source. They give the e value na. That only we need to consider. They are thinking okay. We know how to compute. Now, see, e to the power 0.03 they have considered, e to the power 0.04. The difference is e to the power 0.01. That is the difference between these two numbers. Correct? Now, e to the power 0.0033. This is what you need to add. Very simple, pa. E to the power 0.033 you need to get. This is nothing but, okay, e to the power 0.01, okay, 33% of e to the power 0.01 value plus this value. Are you understanding? Very simple, yeah. Inge e to the power 0.033 is nothing. See, 0.01036, you have this e to the power 0.01 difference value into 33% you apply. Okay, I'll 0.01036 into 33%. Roughly you are getting 0.003418 as rounding off, 342 instead as rounded off. Correct? 0.00342 some number. This is the value you are getting. Correct? This only you need to add e to the power 0.03. E to the power 0.03, okay, plus e to the power 0.0033 will give you e to the power 0.0333. Are you understanding what they are doing? Appo simply add 1.03045 plus 0.00342. Correct? Inge they have done. Can you see this? This you will get it as 1.0. Or what you can do, you can take e to the power 04 value, 1.04, some number here, 081 minus 67%. Because you are reducing now, you are taking a higher value now, you will reduce. Up minus 0.00694 if you do, still you will get the same value, 1.03387. Are you all understanding? So this is the only thing. Okay, June contract, simply you can compute e to the power 0.05. They have given in the question. You will find it out. Next, sell. Okay, what hedging? What they have asked? Okay, number of 50 contracts. If we decide to hedge using until June, upper June futures you will consider. If you want to hedge until June, which futures you will consider? May futures. You have May futures. See, I will tell you. Currently, there is May futures quoting in the market. April, you are in April 1. Up there will be 3 futures quoted in the market. April futures, May futures, June futures. Either which futures you will consider out of this for hedging this, cash segment. See, if you want to hedge your portfolio until June, that's what they have mentioned. You cannot hedge using May futures. Yeah, you can hedge. I'm not telling you cannot hedge. Okay, in the currency futures segment, we have a separate question where we discuss, the regular batch we discuss, there is a question where we discuss that, okay, you can even hedge, there will be a mismatch, maturity mismatch, we will study in the futures. Not necessary that you will always have in the futures market, maturity is also a problem. For futures market, there will not be necessary an instrument which is having a same period, maturity period, okay, which you want to decide, up to which you decide to hedge. Are you listening what I am trying to say? Which means you want to hedge till 4 months. Sometimes market only 2 months futures will be available. Whether you can hedge, yes you can hedge, but the problem is there will be some difference, okay, in the hedging. Hedging will not be proper. Either compensate pandrathu, to compensate the maturity mismatch, okay, we take position, okay, by taking higher contracts, okay, higher number of contracts, by taking position in higher number of contracts. Are you understanding what I am trying to say? If you hedged by taking 200 contracts, in this case, if there is a maturity mismatch, we take 400 contracts or 500 contracts, corresponding contracts to, offset the problem. Then futures will never be perfectly hedged. That is the reason. Okay, so June futures is there na. Appa June futures we will consider and hedge. Here they have already given. Here we have 2 futures exactly, June futures, May futures. Why I am telling you? Sometime in a rend futures they have asked both the futures value, correct? Theoretical value, both the value they have given. Concentration, but sometimes in the spark there should be presence of mind. In the examination, what happens? No problem. But student's mistake, that is not a mistake of the student. But sometimes, accidentally they might take May futures theoretical value. This is one more point I wanted to clarify. But June futures, you should focus June future, you would consider and find out. Very simple, hedging June futures, because theoretical May futures value is that, yes, see, May and this is not May, this is actually June. Okay, May futures value is this much, that we already found out. This is June, correct? June the value is 8935.8. This should be taken, correct? This is theoretical. Yeah, this is the price of the futures. But for hedging, you should take fair futures price, actual futures price, actual futures price. Actual futures price given yes, quoted futures price for June is given as 8850. That only you need to consider for hedging. In the previous question I told you, in this question we are applying that. Are you listening? Sorry, for hedging, okay, here quoted price is different from fair price. That is why we need to consider quoted price. 8850. Are you listening? So 9,94,000 is the cash market value divided by 8850, quoted futures price for June futures, into 25, the lot size you will get, okay, into beta, you will get the total value. Okay, what is that? Okay. Sorry, divided by this number. That 9,94,450 divided by, okay, like this we need to write. Okay, I have shown like this, but I should have put like this, into 25. Okay, this is the into 1.102. Are you understanding? This is how you will get a value contract. For 5 contracts you will get, say 50% of the portfolio if you hedge, just multiply the portfolio value into 0.5, 50%, you will get as 3 contracts. Are you understanding? Say, portfolio hedging, one more question. Here also all these things are same. Beta computation will remain same. Only catch a risk-free rate, how you can add and find out, that I wanted to clarify. The investor thinks that risk of the portfolio is very high, wants to reduce the portfolio beta to 0.1. Okay, that is not an issue. You will, portfolio beta you will find. Okay, first step portfolio beta they have asked, you will compute, correct? Next, value of the securities to be acquired. How to compute the value of securities to be acquired? In your portfolio, you will see, in the portfolio, you are reducing the beta, correct? If risk-free securities, see, you have risky securities, equity shares. If you add risk-free securities to your portfolio, your risk will reduce, ultimately reduce. Why it will reduce? Risk-free securities or beta is always 0. What is the correlation between risk-free security and the market? No correlation. Are you understanding? Beta of the risk-free security will be always 0. If you mix the beta of the portfolio beta, some number you got now, portfolio beta. What is the portfolio beta in this question? What is the portfolio beta for this question? 1.3. Portfolio beta is 1.3. When you want to reduce the portfolio beta, if 1.3 is the portfolio beta and you include a zero risk portfolio, zero risk security inside your portfolio, naturally your portfolio risk will reduce, correct? You need to reduce, but I need to reduce in such a manner that my beta even after reduction will remain to 0.91. Are you understanding? That is what they are asking. So in that case, how much securities I need to buy in? How much risk-free securities which is having a 0 beta I need to put in the portfolio. How to solve the equation? Very simple. Target beta is 0.91. Let the proportion of the risk-free securities to the target beta is equal to 0.91. Let it be P. Very simple. You have portfolio, you have risk-free asset, correct? Portfolio beta is how much? 1.3. Risk-free security beta is how much? 0. 0, correct? If 0, what you need to do is that you need to form an equation. 1.3. What is the proportion of this portfolio? Given not proportion of this risk-free securities not given. Okay, you don't know the proportion of risk-free securities and portfolio naturally. Proportion of risk-free security you assume as P, correct? 0 into P, anyway 0 is plus portfolio beta. Okay, should be 0.91 na. What is portfolio beta? Weighted average security is inside the portfolio, correct? Portfolio beta is nothing but weighted average beta inside this portfolio, correct? Now, zero debt security will have risk-free security. This is what I say. Yes, risk-free security will have 0 beta. 0 into P plus you have other securities which is forming part of the portfolio, beta of 1.3 into 1 minus P, because see, even though you don't have only 2 securities in there, you will segregate the entire portfolio into one. Other than risk-free securities, you will consider it as 1. Are you listening what I'm trying to say? See, you will group all the risky securities as one single portfolio which is having a beta of 1.3 portfolio beta. This we group, assume. In the group, in this group, you are adding one more risk-free security which is having a beta of 0. Now, I don't need a proportion, I don't need to find the proportion of A limited, B limited, C limited inside the portfolio. I don't need that proportion. I only need the proportion of the risk-free security. Balance will be out of 100%. The portfolio in the 3 stocks, the portfolio consists of this A limited, B limited, C limited, will have 1 minus P. Are you listening? That is what I am solving. 1 minus 3, 1.3 into 1 minus P plus 0 into P. The total should be 0.91. 0.91 should be the total. Weighted average beta. This is the required beta. Now, if we solve it, okay, we will get the total value 5,000. 5,000 lakhs into 30%. Oh, we got the P as 30%. Upper risk-free security or weight is 30%, which means, okay, risk-free security to be acquired is how much? 30%. 5,000 worth shares. 30% of the risk-free security you need to throw, you need to sell, and you need to bring in 30% of the risk-free, 5,000 lakhs as risk-free security, that is 1,500 lakhs, 1,500 lakhs. Are you listening? Number of shares to be disposed of, corresponding, very simple. Out of the 1,500 lakhs, this is the total. This comes to 1,500 total. This is the total of 450, 900 and 150. Correct? Very simple. 1,500 lakhs is the total value to be disposed of. Correct? Either proportion weight you already know, 0.3, 0.6 and 0.10. Correct? Market price you will consider. You will get number of shares to be disposed of. Either lakhs don't think it is beta. The lakhs number of shares. Okay? This is how you will do. Correct? Number of Nifty contract to be sold. Very simple. 1.3 minus 0.91 into 5,000 lakhs. Okay, divided by 8,125. Sorry, it is 8,125, which is quoted futures price. In this question they have given quoted futures price of 8,195. Where they have given see, number of Nifty to be brought and sold. Yes, 8,000. Take C. 8.19 8,125, because currently traded. Quoted price you should consider and find number of contracts. All this I discuss. I don't want to discuss again and again. Okay. 2% Nifty rise in Nifty is accompanied by 2.6. Yes, this is very important. Last part is very important. That's why I added the question here. Yes, this part is very, very important. Okay, see here. What they are asking in the last segment. The value of the portfolio beta if there is 2% rise in the Nifty. Okay, what will be the value of the portfolio beta for 2% rise in Nifty? Assume that rise in Nifty raised is increased by 2%. Nifty increased by 2%. Correct? Now, Nifty increased by 2%. Portfolio, okay, the entire portfolio beta we found out as 1.3. Correct? See, the beta of the portfolio is 1.3. Entire portfolio, cash market, entire portfolio beta is 1.3. Correct? Nifty, okay, if it is increased by 2%, okay, what will happen? How much will be the corresponding increase in portfolio, your portfolio? See, beta times the portfolio I told you. Up 1.3 into 2%. If Nifty changes by 2%, our portfolio value will change by, Nifty increase by 2%. Our portfolio will increase by how much percent? 2.6%. Correct? Are you understanding? 2 into 1.3, which is 2.6. Apo, current value of the portfolio shares, 5,000 shares, you start from there. What they have asked in this question, very simple, what they have asked, ultimately, they have asked us to compute value of the portfolio beta for 2% rise in Nifty. Currently, the portfolio beta is 1.3. Correct? But what will happen in case Nifty futures is rising by 2%? Actually, there is no clarity. That there is, see, one more thing in the question, what is the ambiguity, I will tell you. The 2% rise in Nifty is there, Okay, Nifty futures and Nifty, okay, are correlated, but not at the same rate they will increase. Just like shares, ITC futures will rise in case ITC spot is rising, ITC future also will rise. But the problem is, the rate at which the both are increasing will not be same. In this case, what happens? Okay, 2% rise in Nifty, okay, this is not Nifty, this is Nifty, Nifty futures, there is no clarity. Are you understanding? Okay. Now we will solve the question as per the suggested answers. Okay, then we will understand how they have considered. What assumption they have taken, we will understand. See, current value of portfolio is 5,000 lakhs. Value of the portfolio after Nifty increases by 2%. Correct? See, for every 2% rise in Nifty, okay, portfolio is raised by 2.6% na beta, because 1.3 is the beta of the portfolio. There is increase. Your portfolio value increased by 2.6%. Portfolio value became 5130 when the Nifty raises by 2%. Correct? Now, mark to market margin paid. From here, margin will be paid. Why margin is to be paid na? See, very simple. Inge you have buy position. See, cash market, futures market. Cash market you have buy position or long position. Na? Portfolio is long portfolio. You are holding the portfolio. Na? What is the meaning? Long. But short the futures, you need to, in the previous questions you solved, na? How much contract you need to sell. Here, short position. In the futures market, you have taken short position. When you take a short position and there is a rise in the futures market, are you understanding what I am trying to say? If you have taken short position, okay, and the price is increasing, you have shorted Reliance at 200, okay, and the price became 220, you will incur loss or profit? Loss happens now. What will happen? Margin account will get reduced or increased. To that extent, margin account will reduce. MTM procedure we discussed, margin account will reduce. How much margin account? Very simple. 8125 the futures price, 2% is the margin. Correct? 200 is the value and into this much. Are you understanding? See, number of contracts, everything we need to understand. 120 contracts is there. If 120 contracts we will consider, 200 is the lot size. Yes, 200 is the number of units per contract, and 2% is the loss. 2% rise in Nifty. Correct? 2% is the loss. How much increased price? 2%. That will be adjusted through margin account. Correct? How much it comes to? 39. Are you understanding? Everything in lakhs? I think lakhs. Yes, everything in lakhs. 39 lakhs. Actually, it should be shown as outflow. Yeah, I will show as outflow. Your portfolio value had 5130. Correct? Inge 39 value will be reduced to the extent of 39 because of loss in the futures market. Ultimately the value reduced. See, there is a cash market value of 5130, futures market value of 39. Correct? Loss in futures market, loss of 39, which will be adjusted. Correct? Net balance value in the cash portfolio value in 5091. Net portfolio value is how much? Value of the portfolio after rise and increase. Because if Nifty increases, futures will reduce. Change in value in the portfolio. How much is the change in value in the portfolio? 1.82%. Are you all understanding? Portfolio, percentage terms, what is the change I am considering? 1.82% is the change. If 1.82% is the change for 2% rise in the Nifty, this is 2% rise in the Nifty. For every 2% rise in the Nifty, okay, the change is in the portfolio is 1.82. For beta, beta is nothing but, okay, what is the change in portfolio value or change in security value with respect to the change in market value or Nifty? Inge, for every 1% change in Nifty, 2%, 1.82% is the change. So for every 1%, okay, for every 1%, the change in portfolio value is 0.91, which means it is nothing but beta. The revised beta will be 0.91. Earlier, to put it simply, okay, earlier the beta value was 1.3 lakhs. Are you understanding? Before futures hedging, the cash market position, the portfolio beta was having a value of 1.3, and through beta hedging, we effectively reduced the portfolio value to beta value to 0.91. Are you understanding the risk strategy? Inge only one question arises. Correct? Inge change in value of the portfolio is there, correct? 1.82% is, that is true. 2% rise in Nifty is there. Here, see, if you see the mark to market margin is there, 2% margin will be deducted in case where Nifty futures you will adjust. Are you understanding what I am trying to say? Very simple, cash market position, leave cash market position aside. For now, forget about cash market position. I'll come back to that. Futures market, assume you have sold at rupees 200. It is a simple example. You have sold some share at 200 rupees, and okay, if you sold at 200, if price decreases, you will have profit. Instead, price increased, correct? In this case, price increased, so you have a loss, correct? Are you listening what I am trying to say? This loss, okay, will be corresponding, loss will be taken with respect to the futures price, not the spot index price. Are you understanding? Futures you are sold na, what is the price in futures? You have to see futures 220 due to the rise in Nifty, spot Nifty are you listening? Futures the price is 220. Two things are there. Spot Nifty is there, correct? Spot Nifty may rise 2%. Nifty futures may rise 2.2%. Are you listening? So possible na, correct? In that case, you have to consider the loss in the margin account. The loss which is to be deducted will be considered by taking futures price into account and not by the spot Nifty. Are you listening? What I am trying to say, that is the difference. In this question, since there is absence of information, further information, we assume there is 2% rise in Nifty which is there is exactly same in the futures market also. If a Nifty, spot Nifty 2% rise, because beta will never capture futures price change due to the market index. Are you listening what I am trying to say? Beta captures, beta captures what? Are you listening what I am trying to say? Beta captures for every index 1% change in index, market index, not index futures. Listening? What is the change in portfolio value? So we assume that this 2% rise in Nifty, this is to be treated as index, and while computing there, you understood the anomaly, question understood? Inge 1% rise in Nifty is captured by the beta. But the problem is, Nifty futures may not change at the same rate. Correct? So we assume that the 2% rise in the Nifty is same in the spot Nifty as well as the future Nifty. Are you understanding? That is the only way to solve this. Seriya? All this I have just clarified. No need for your understanding. But this is very important. You need to understand. In the question, sometimes when you learn conceptually, this doubt will arise in this question. Next, question number 17. Commodity futures. Quickly, I will just brush through. Two or three questions are there. Yes, with that I will close the session. What is that? 2 or 3 questions? Yes, these questions you can manage. I have just given that. You can go through, but there is nothing to be discussed. Commodity futures. One hedge ratio is given. I'll just briefly discuss that question and close the future session. See here. A company is long on 10 MT of copper at 534 per kg and intends to remain so far in ensuing quarter. The variance of change in its spot and future prices is 16%, 36% respectively. Upper spot 16% change, futures market 36% change, having effective correlation of 0.75. The contract size is 1000 kgs. Calculate the optimum hedge ratio for perfect hedging in futures market. Hedge ratio, what is to be computed here? Very simple. Hedge ratio will be computed. We have a formula. Hedge ratio. See here. Change in spot price divided by change in futures price. This is what you need to consider. This is the hedge ratio. In the option segment, next segment I will going to revise anyway. There I will detailedly discuss the option valuation. You have something called as delta hedging. Something similar to what do you say, in the bond market we studied volatility. Remember, duration divided by 1 plus YTM. Volatility we studied is nothing but sensitivity of the bond price with respect to the YTM. Correct? Same way here also we need to find the sensitivity of the spot price with respect to the futures price, which means when you are hedging, you will hedge the sensitivity of the change in spot price divided by change in futures price. For every 1 rupee change in futures price, what is the change in spot price you need to consider? Then only you will take appropriate hedging position. But apart from that, you will consider, what is that? Correlation also. Correlation also you will consider. This is nothing but beta hedging. I will tell you why. This is see here, into correlation. Correlation is given as into correlation. Correlation is denoted by ARP. Why this is given? Standard deviation of change in spot price by standard deviation of change in futures price into R. If you observe in the portfolio management chapter we are going to study, risk of the individual security divided by risk of market into correlation of S and M. Security into market is nothing but beta. Are you all understanding? This is the concept. Same concept they are trying to apply. Are you all listening? Which means here instead of market I will consider futures, because using futures only you are trying to hedge. Understanding what I'm trying to say? Inge futures you are using to hedge the commodity futures you are using to hedge the spot commodity, correct? That is why what you do, okay, change in spot price, okay, standard deviation of the changing spot price you will consider divided by standard deviation of the change in futures price you will consider into correlation of the spot and futures you will consider and find it out. This is effectively beta dhampa. This is effectively something similar to beta. Are you understanding? Hedge ratio we have to compute. To put it simply, first we need to compute standard deviation of change in spot. See, the variance of change in spot and future given. Upon the change in spot 16% given for spot, 36% is given for futures. Standard deviation, this is variance, correct? Now you will you need standard deviation of change in spot price, variance of change in spot price, standard deviation. Okay, upper variance, now standard deviation is nothing but square root of the variance. Okay, portfolio management we will study. Upper 16th root of 16 is equal to 4 divided by 36th root. How much is that? 36 square root in a 6. Are you understanding? 4 by 6. This is the hedge ratio. 4 by 6 na 0.75. Yeah? Yes. See here into, see, this is 4 by 6 into what is that? Correlation 0.75. How much is that? 4 by 6 into 0.75, 0.5. This is the hedge ratio you need to consider. Are you listening? Up a very simple pa, in cash market position should be 534. What is a cash market position? We will understand. Commodity spot la 534 per kg MT, correct? Up a 1000 kg, one contract is 1000 kgs, futures contract is 1000 kgs. Okay, up a 534. See here, what you need cash market position. Since the company is long positions, what position you need to take? Up since the company is long position in the spot market, it shall take short position in futures market. Since contract size is 1000 kg, na, number of contracts you need to take, okay, 10,000 kgs, one MT is 10,000 kgs divided by 1000 kgs into 0.5, correct? To hedge appropriately. Up 5 contracts you will take. Up amount 5 into 1000 into 534 is nothing but 26,70,000. This is the futures value. Futures value you will take for hedging. Are you understanding? That is what they are asking now. Futures value. Determine the number and the amount of the copper futures. The amount, not total value of the copper futures to achieve a perfect hedge. Are you listening? Okay. Just to go through one more question. Simple profit and loss question we will see and close the session. Okay. All this we have already discussed. Nothing new here. Okay. The hedge ratio only new thing that you want to discuss. Don't worry. You will not have absolute clarity here. Options we have delta hedging. Okay, method, binomial model, delta hedging we will discuss. There you will have absolute clarity. Okay, see. Come to the question number 18. A rice trader has planned to sell 22,000 kg of rice after 3 months from now. Spot price of the rice is 60 per kg. 3 months future on the same is trading as 59 per kg. Size of the contract is 1000 kg. The expected price to be 56 kg 3 months hence. Okay. To interpret the position of trader in the cash market. Very simple, yeah. Cash market has planned to sell 20 after 3 months from now. Which means if he want to sell after 3 months, na, today he will buy, na, he has to have the rice. Na. Are you understanding? Rice trader, he wants to sell after 3 months. Na. Today what position he will have in the cash market? Buy position. Simple question. Next, to advise the trader whether he should take in future market to mitigate his risk of reduced profit. Okay, the position he should take. Okay, to advise the trader, the position he should take in futures market to mitigate his risk. What position he should take in the futures market? Obviously, future what you want to do, you will do in the spot. Correct? Future you want to sell. Okay, what you want to do in futures, you will take the position in the futures market. Upper spot futures, what you will do? Sell futures today. Today you will sell futures. Correct? To demonstrate the effective realized price for its sale, if he decides to make use of future market and after 3 months spot price is 57 per kg and futures contract price for closing the contract is 58 per kg. See here, this is since plan to sell after 3 months, it is long position cash market, already did. Okay, mitigate the risk by taking risk of reduced hedge position by selling rice futures, that also we did. Last we are going to see gain in the futures market. Okay, contract what happened we need to see. See here, I will take this place cash market position, future market position. Correct? Future cash market he buy, future he sold. He sold at futures market. He sold at what price? Please tell me at what price he sold today. Futures market. What is the 59 per kg. Are you all listening? Okay, 59 per kg is the price of the futures today. Appa he sold today, the agreed upon price is, selling price is 59. Now he wants to close the position. What they are asking? Effective realized price for its sale if he decides to make use of future market. Spot price is given. What happens to spot and futures? We will compare and find out gain or loss. Are you understanding? First, futures market la, okay, future contract price for closing the contract is 58 per kg. Are you listening? Futures la, you today took a sell position. You will take a counter buy position. Buy position at what price you will buy back? 58 per kg. Futures you will close at 58 per kg, which is quoted after 3 months. Correct? After the on the date of maturity. What is the buy? You will give at 58. You sold at 59. You buy at 58. What is the profit? Gain is equal to 1 per kg. Agreed? Rupee 1 per kg is the profit. Is it profit? Yes, profit. Are you listening? Come to cash segment. Cash la, you have a long position. Today you have cash market la. What is the price? Spot price of the rice is 60 per kg. Are you understanding what I am trying to say? 60 per kg is the spot market price. Correct? And on the date of maturity, the spot price became how much? The spot price became how much? On the date of maturity, the spot price became 57. Correct? Are you listening what I am trying to say? 57 is the spot. See, today what is the value? You forget. Today you bought it. You have not bought it. You have open position. See, plan to sell. Correct. Rice is 60 per kg. Assume it is 60. Today you have not bought the rice. Assume you have in hand. The market value of the rice in hand is 60 per kg. Okay, the cash price after 3 months, spot price after 3 months, okay, is 57 effectively. Correct? Your selling price, you will realize some amount. Your selling price will be at 57. You will sell only after 3 months. Correct? Inge net cash settlement is happening. Inge settlement is by way of, Inge settlement is, you are physically selling it. Okay. That is the understanding from the question. 57 into how many kgs? See here, 22,000 kg. 22,000 into 57. What is the value? 12 lakh 22k is equal to 12 lakh 54,000. This is the effective sales value. Sales value is nothing but 12 lakh 54,000. After 3 months in the spot market, you will sell the rice for how much? 12 lakh 54,000. Agreed? Now, apart from this, you will have gain from the futures market 1 rupee per kg. How many kgs? 22,000 kg. That you will add up a total cash flow which you will receive. Sales value realization will be how much? 12 lakh 54,000 plus 22,000, which is 12 lakh 76,000 effectively. Up a cash flow per kg is how much? 12 lakh 76,000 divided by 22,000 is equal to 58 per kg. This is the solution for this question. But one point you need to understand conceptually. You don't need to do all these things effectively. Okay, you have already sold it for 58 see here. Effectively what happens, I will tell you. Effectively the buying price is 58. Are you listening what I am trying to say? Effectively the buying price is 58. Correct? See here. See. The futures contract closing price is effectively 58. That became the ultimate price at which you are, you are realizing. Are you listening? Per kg price which you are realizing is 58. This is nothing but the price of the futures contract. Are you listening? Effectively, by taking these two positions, you have hedged. Why? Because yes, 50, today 60 per kg is the price. But I expect that the price will even drop to 56 per kg. Today's value is 60 per kg. But I expect in the future it will become 56 rupees. 56 rupees per kg into 22,000 you put it. I fear, okay, see today, what is the value of realization today? 22,000 into 60. How much is this? 22,000 into 60 is 13 lakh 20,000. 13 lakh 20,000. Correct? 22k into 56 na, how much it will become? 22,000 into 56, 12 lakhs 32,000, which means I fear at present the value of my, the commodity is 13 lakhs 20,000. I fear that the value tomorrow might become 12 lakh 32,000. I need to hedge my position. Are you listening? While you hedge your position, okay, effectively even though you cannot realize 13,20,000, of course, no issues. I know that the price is going to drop. But somehow I saved myself by losing, losing lesser amount of value. 12 lakh 30, instead of 12 lakh 30, my value dropping to 12 lakh 32,000, my value became 12 lakh 74,000. What is the revised value? 12 lakh 76,000 by futures hedging. Are you understanding? The value became 12 lakh 76,000 instead of 12 lakh 32,000. Okay, this happened and effectively the price became 58 instead of 56 per kg. Even though the spot price is 60, I couldn't realize the 60 today because ultimately the value is getting diminished tomorrow. But the value ultimately is not reduced to 56. Effectively, it became 58 per kg. I can, even though the spot price is 56, I can effectively sell at the average price of 58 due to the profit I earned from the futures market. This is just discussion purpose. I just discussed. No need for all profit and loss computation. If you know how to compute, that is enough. What is the sale realization value? That is what they are asking now. Effective realized price. That's what they have asked. Are you understanding? This is not required for examination. Just discussing to understand the concept further. Say, are you listening? Say, last question given. You can go through. There's nothing important in this question. Similar type of question. Okay. What I wanted to really clarify, maybe, yes, okay, Nifty price rise now, what will happen? Individual share price now, what will happen? You need to compute P&L. That's why I have given in the question. This we already know. The similar type of question, yes, similar type of question. In the last point only, I wanted to clarify. In the question A, why I gave na? Okay, this is institute question. Nothing I've given. Okay, this is institute question. See here. Here. Yes, last point is the important point. Okay, weightage only 1 or 2 marks it may carry, but still a good point. Is it possible stock as well as Nifty to raise or fall at the same percentage? Please state the reason. Are you understanding? That is why, see, the depth otherwise you won't understand what they've asked. Are you understanding? Normally it is not possible that stocks as well as index, Nifty na index, to rise fall at the same percentage because of systematic risk. Okay, beta may not be the same as of market. Beta will not be same. Are you understanding? It will never happen. Say, this is for stock only they've asked. Okay, then maybe in the future they may ask for futures also. Futures also, I told you, it will not be falling or increasing by same rate. That also you need to understand. Say, with this I'm closing the session of the futures. Okay, we'll see the next segment. We will revise the chapter called as options. Options in derivative segments we will revise. Then we will move on to portfolio and other topics. Okay, thank you.